prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Good morning. Here are your top stories. Bonds battered, Treasury yields surge, with the 2-year topping 1% for the first time since early 2020. Oil markets roiled. Brent hits a 7-year high as a drone strike on Abu Dhabi sparks tensions and accusations fly. Boris Johnson's former top aide, Dominic Cummings, accusing the Prime Minister of lying to Parliament about rule-breaking parties.
Now let's take a look at the futures, Tom, and certainly we're not without a direction today. It's very clear that the markets are anxious about Fed rate hikes being more pronounced and coming quicker, or not aggressively, more aggressively than actually they're pricing in. So we're seeing, of course, a number of moves on treasuries. That 2-year yield, 1%, it's a quite big psychological level, and then yield curve flattening.
Yeah, particularly at the front end, as you point out, the 2-year breaking above 1%. We're looking, of course, at German bunds as well. Will they break above zero today? That is in focus for us as the markets readjust to a more aggressive forecast for the Fed amid this inflation. Has the market, the bond market in particular, been overly complacent, and will the resilience, the relative resilience that we see in the equity markets continue given the run-up in yields? We will focus on tech specifically as a result of that. The FTSE 100 down 0.3% just in the first few seconds. The CAC lowered by 29 points. The Spanish IBEX down by 0.3. We had some data around European car registrations dropping 22% in the month of December, but down about 1.5% for last year. Again, supply chains, bottlenecks, semiconductors. In the UK, you had some job numbers. The picture improving for September to November. Of course, that was really the surge in Omicron. Let's change it on, see how things are breaking out then across the assets. So as you look to the futures, the US back to trading after that bank holiday yesterday. The futures pointing lower by 0.5%. This is the US 2-year yield then. The yields have moved up, of course, in the last 24 hours quite aggressively, more than 10 basis points, currently above that 1%. We're focusing on in the yen as well. The BOJ standing pat, but changing the language around inflation. Are you going to see more pressure on the yen then as you see this divergence between the BOJ and the Fed, currently at 114, and Brent as well, given the geopolitics and that drone strike in the UAE amid a picture of stronger demand and the inability of some of these producers to meet their commitments, you're seeing gains of 0.2% for Brent. More than 1%, 1.8% in fact, for Brent, currently at $88 a barrel. Goldman Sachs as well, updating their forecast for the third quarter, $100 a barrel. Fran.
If we look a little deeper into some of the sectors that are moving, I think energy, of course, and technology and travel are some of the biggest losers. So you can see actually energy a little bit up on the side. Now, Brent touching a psychological level. This is, as we remind ourselves, actually some of the geopolitical, of course, concerns are usually short-lived for the oil market. What is not short-lived is actually that demand could pick up because Omicron is possibly not as deadly as we thought it was. So as Tom was saying, a lot of these European stocks down some 0.5%, energy on the way up a touch, but everything else on the way down, Tom.
So that's the broader picture, negative broadly across these equity markets. Then you have the individual corporate stories. Rio Tinto talking about a challenging fourth quarter in terms of production. That stock down 0.5%. THG, formerly the Hut Group, lower by almost 2%. Their profits missing estimates, lowering their forecast. Growth challenges they faced as well. Input prices, commodity prices that have been challenging for them. That's been flagged by that company. ST Micro, we just pulled this one out because, of course, it is a major tech name here in Europe, and we're looking at this higher yield environment, how that translates across the tech space. Currently down almost 1%. Okay, let's get the Bloomberg Business Flash with Laura Wright. Laura.
Thanks, Tom. Activision Blizzard has reportedly fired or disciplined more than 70 employees since July as part of efforts to address allegations of sexual harassment and other misconduct. The Wall Street Journal says CEO Bobby Kotick held back a report on the actions, worried about Activision's reputation. A July lawsuit accused the company of fostering a frat boy culture of sexual harassment and discrimination. EDF has been hit with a credit rating cut and was warned over further downgrades. That's after the French state-controlled utility was ordered by the government to sell more power at a steep discount under action to tackle Europe's energy crisis. EDF plunged on the plans, which could cost it as much as 8.4 billion euros. Crypto.com says it stopped all deposits and withdrawals while it investigates unauthorized activity on some accounts. The crypto wallet provider and trading platform tweeted that all funds are safe, but that security is being enhanced. Several users had recently used social media to report the alleged disappearance of funds. That's the Bloomberg Business Flash. Tom, Francine.
Thanks so much, Laura. Laura Wright in London. U.S. Treasuries slumping across the curve with the front end, leading the decline. Two-year Treasury yields rising above 1% for the first time since 2020. Investors betting that the Fed will tighten policy faster than expected. Now let's get into some of the key market drivers with our markets editor, Christina Aquino. We're also joined by Louise Dudley, portfolio manager for global equities at Federated Hermes. So thank you both for joining us. Louise, we have 1,000,001 questions on equities, but Christine, it's very clear that there's a repricing in the markets. If you look at swaps, they're now expecting 4 rate hikes this year. Why?
Well, Francine, I think it really is all about that inflation print, right? That indication that prices in the U.S. in particular are rising at the fastest pace in 4 decades. That is a staggering level. We've heard from the Federal Reserve officials that this is precisely what they want to respond to. They've been very emphatic about wanting to tackle the price issues, and that's essentially what markets are pricing in now at the moment.
Okay, just before we get to Louise, just a redhead crossing the terminal. Toyota, the Japanese car maker, expecting to miss its 9 million unit goal in terms of full-year global output. That was the target for the full year, 9 million units. Toyota saying it expects to miss that, no doubt, as a result, likely, of those shortages that the auto sector has faced in terms of supply chain constraints and semiconductors. Louise Dudley, let's bring you in at this point then, and thank you for joining us this morning. Are the markets still playing catch-up in terms of pricing in these Fed hikes, or are they getting over their skis now?
I think there's a little bit of, realization that Q4 maybe is going to be the last quarter where we see some double-digit growth, and looking to 2022, things are normalizing a little bit more. So people are revising that. Expectations on GDP also coming down. Valuations getting tighter. So yeah, there's still a little bit of catch-up to go, I think, on that.
So, Louise, are you expecting a big correction actually for equities overall, and is it U.S. equities that will suffer the most?
Not a big correction. I think, it's about being selective amongst those multiples that have kind of run away from everyone. We did on Friday, obviously, in terms of some of the kind of earnings previews that we get from some of the banks, some of those names didn't hold up. So, expectations were too high, despite their quite favourable outlook to a certain extent relative to some other sectors. So it is a case that we do expect a little bit of normalisation, but not too much of an overall correction. And I think, there will be some strong earnings coming through, and that will help to hold up certain areas of the market. And that's more of the kind of structural growth names, the names that haven't got carried away in terms of valuation from last year.
And Christine, a jolt to the energy markets overnight with this geopolitical event, the attack on the UAE. We'll get into the details of the geopolitics later in the show, but in terms of the structural forces underpinning oil at this point, and Goldman Sachs now predicting $100 a barrel, how does that filter out across the equity space?
Well, Tom, I think it is adding to the worries that equity investors are looking at the moment. They're not just looking at this higher yield environment, which does squeeze some of those juice that we see from particularly the higher growth sectors, but then you add in the inflation impulse, and in oil prices in particular, adding to that inflation impulse, then that really creates a sort of double whammy environment that could potentially hit risk assets and stocks in particular. And I think, yeah, it is very interesting that, we're seeing these simultaneous moves now. It's one thing where, investors are having to deal with just the yield move or just the rise in oil prices and commodity prices, but this sort of double whammy situation that we're seeing at the moment will really test risk appetite at this point.
Louise, talking about risk appetite, what do you do with UK assets right now? So we have that inflation print, and it's clear, or at least the market is probably pricing in another move by the Bank of England very soon.
Yeah, I mean, the thing about the UK is obviously very skewed towards financials, but also commodities, which are actually two areas of the market that do have some of those, what are seen as kind of negatives for other sectors, actually positive for them. So actually not looking too bad for the UK, to add into the other kind of mix of negatives to a certain extent that companies are looking at. You've also got this tight labour market, and that's definitely something that's also apparent within the UK. But again, the UK has maybe a bit more of a services skew, so maybe a bit more favourable relative to some of the other areas, more industrial markets within Europe.
Okay, and the 10-year yield on UK gilts rising to 1.2%. That's the highest since October. We're going to have plenty more with Louise Dudley, portfolio manager for global equities of Federated Hermes, who's going to be staying with us. Christine Aquino from our markets team as well. Coming up, Yemen's Houthi fighters claim to have launched a drone strike on the UAE. We will discuss the geopolitical tensions and their impact on the oil market in more detail. That's after the break. The details. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Welcome back to the Open. We are 12 minutes into the European trading day. Losses of more than 0.8% across the benchmark Stux at 600 here in Europe. Top of the list in terms of your sectors, not a big surprise given the run-up in yields. We've seen technology down at more than 1.3%. The one sector that remains in the green, energy, given the run-up in oil prices, currently Brent at $87 a barrel, up more than almost 1.5%. Goldman with a forecast of $100 a barrel in the third quarter. Okay, talking of Brent crude and what is underpinning these high prices, rallying to 2014 highs as geopolitical tensions stir in the region. Yemen's Houthi fighters claim to have launched a drone strike on the UAE, OPEC's third biggest producer. Let's go to our oil reporter then, Paul Wallace, who is in Dubai. Paul, what do we know then about this attack on Abu Dhabi, and what is the impact? Obviously, we're seeing elevated prices. Does it remain sustained, the geopolitical risk around these tensions?
Hi, Tom. So the Iranian-backed Houthis claim to have struck two targets in Abu Dhabi yesterday, the main airport in the city, and also an industrial area which contained a fuel depot. And while we don't know just how successful the attacks were, the UAE said they were probably caused by drones, and they did cause blasts at the airport and in this industrial area. The oil markets more or less shrugged off the incidents yesterday, and they didn't. Traders didn't react much. But we are seeing a reaction this morning, probably from Asian traders, and most of the oil in the Persian Gulf goes to Asia. So that's probably why traders in that part of the world, in Singapore, say, are a bit more concerned. I think the main thing people will be looking for in the oil market is what happens next. Is this repeated, or is it a one-off?
Yeah, and in general, Paul, it's good to remind all of our viewers that a lot of geopolitical concerns, unless they escalate quite severely, are usually short-lived and look through in the market. So does this have the potential to escalate?
Well, that's what we're going to be looking out for. The Houthis are threatening more attacks on the UAE. Essentially, they're saying that the UAE has increased the number of its airstrikes in Yemen, where it's part of a coalition involved in Yemen's civil war. And I guess what yesterday shows is that the Houthis are capable and they are willing to attack the UAE. The UAE has not threatened retaliation itself. It's not actually been that aggressive with its rhetoric so far. But I think if we see more attacks, especially if it leads to anything like a shutdown of energy production or a large number of civilian deaths, that's going to raise the stakes much more.
Okay, so watching for any response from the UAE. Paul Wallace, our oil reporter, thank you for the details on that attack overnight in the UAE. Christine, how should markets be thinking about geopolitical risks now? We've got Russia, Ukraine, we've got the politics, the geopolitics of the Middle East, of course. Do investors need to start pricing in geopolitical risks, and where would they look to put their money to work to hedge against some of these risk factors?
Well, Tom, markets are notoriously bad at pricing geopolitical risks, as we know, but it's certainly something that's reminding them of all these underlying issues that could provide some tail risks to markets. And I think that's essentially how they're looking at some of these flare-ups in the region. Again, you mentioned the Russia situation with Ukraine, of course. We also got some situations in Kazakhstan earlier in the year, and now we have this situation in the UAE. And I forgot
North Korea as well.
Yes, of course. Yeah. And so I think, you know, this is just kind of a constant reminder to markets that, yes, they have kind of this macro picture to consider, but on top of that, layering in all of these kind of potential geopolitical tail risks, yes, it may take a while for them to escalate and really kind of drive the fundamentals of the market, but it's certainly something that they should keep at least half an eye on.
Louise, let's talk about oil fundamentals. A disclaimer, I covered OPEC for like 10 years, and it's still one of the most fun jobs that you can do out there. Let's go back to the wonderful chart that our Valerie put together looking at some of the oil price swings that we've had over the last 12 months. Now, unless something bad happens, the fundamentals are pretty balanced, Louise. So I want to point to what OPEC has been doing. You know, they may well grab the opportunity to open up some of their taps, and actually shale production is also likely to pick up given the price of oil. I don't know if we have that chart. We'll bring it to you shortly. There it is. Some of the beautiful charts that we can do on the Bloomberg terminal. So, Louise, I guess if the fundamentals remain balanced, are we going to be range bound in terms of price for oil?
So I think, we're definitely seeing a lot of continued strength, a lot of demand. We're seeing all those activity numbers hitting very strong numbers. We've obviously, in the next month or so, we've obviously got Chinese holiday. We've also got the Chinese zero COVID policy, which is impacting activity as well. But all those indicators pointing to, a strong rebound, constrained supply, and obviously these new attacks just add to that constraint as well. So definitely expecting things to be tilting upwards. There's definitely a higher skew towards those kind of upper bound. Goldman at 100 may be a bit too optimistic perhaps, but you never know what can happen. And at the same time, we've also got, as well as the other kind of geopolitical risks, you shouldn't forget the options in terms of new variants and those types of rebounds as well, which is also on our radar. We're also looking at, extreme weather events. That's something that's also been cited by the WEF for the next couple of years. We're seeing that in the US as well. So lots of kind of top-down macro things to contend with. But, this earnings season definitely focusing on the fundamentals as companies that have been able to deliver within that environment.
Okay, Louise, and when it comes to the inflationary picture, there seems to be a consensus building that supply chain issues start to be resolved towards the end of this year, but wages remain elevated. Which companies, which sectors of this equity market are best positioned to weather that kind of adjustment?
Yeah, so obviously the companies that have a larger labour force are obviously kind of struggling in terms of hiring and in terms of cost. We've also got those high freight numbers. So any company that's exposed through logistics or they do have a more extended supply chain are struggling. It's also the smaller businesses, which are maybe weaker, they're less flexible, they have less buildup of stock. So overall, that skews towards kind of large cap, it skews towards technology or services businesses, those companies that avoid there's some of those kind of negative impacts from an inflationary perspective. They also have the big kind of energy cost as well. So those companies that maybe have taken a longer term view in terms of energy, maybe hedge some of those costs in the near term, are also going to benefit within this environment as well.
Great. Thank you both for joining us. Christina Kino and Louise Dudley, Portfolio Manager for Global Equities at Federated Hermes. In the meantime, we're also looking at moves from futures over in the U.S. Nasdaq actually falling, futures extending the drop down some 1.5%. Here in Europe, I don't know whether we have a European stocks or sector group, but actually they are following this U.S. futures lower amid the surge in Treasury yields. I'm looking, for example, at the German and U.S. yield curves, slightly bear flatter with the 10-year German yields remaining negative, but very close to 0%. So that's also a level that we're watching out for. Coming up, we'll be talking U.S. banks ahead of Goldman Sachs earnings a little bit later today. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Welcome back to the Open, everyone. 22 minutes into European trading day, and there is quite a lot of going on, I would say, in the fixed income space in general. German bunds, if you look at the 10-year yield, look, they're remaining negative, but very close to 0%. That would be a big deal if they touch that. Gilts a little bit cheaper by, 1.5 basis points across the back end. Then I'm also looking at cash USTs drifting off a little bit lower after a snap at the Asian Open. So a lot going on with fixed income across the board. Let's also focus on U.S. bank earnings. I know they're looking at fixed income ahead of numbers from Goldman Sachs later today. We could not be more delighted to have Danny Berger joining us. Danny, we had JP Morgan, Citi last week. Today it's Goldman Sachs. Is it a different set of numbers that we'd be looking at?
It's really likely the same pain points for Goldman than it has been for the others, because it is this macro story that's been really difficult for banks. Yes, we've had trading on Wall Street, that boom, really tough comparables from last year, but even though we knew that, they still miss estimates. The issue here, and it certainly will be a problem for Goldman, is this boom is fading at the same time when costs are going up. And of course, it didn't come empty-handed. I brought a chart with me looking at JP Morgan specifically, because I'm always going to bring a chart with me.
Because happy Christmas.
Because happy Christmas. Happy belated Christmas. So JP Morgan, yes, we saw their revenue continue to push higher, but expenses also grow 8.6% year over year. So that means they totaled about $77 billion.
The chart is coming.
Okay, perfect. There we go. Beautiful. I love it. So this is JP Morgan specifically, but Goldman's also going to face this problem. The white bars there are expenses. Goldman, Bloomberg learned on Friday, is set to give a one-time payout of $1 million plus to its partners each. So, expenses hugely in focus.
Investments in technology in JP Morgan.
Now that's exciting.
Francine poo-pooed this yesterday.
That's exciting. 12 billion.
I think it's interesting.
No, it absolutely is.
Okay, but we're going to move on from that because Fran's not convinced. So loan growth. Talk about loan growth. Is that the upside for the banks?
Yeah, look, we've chosen the complete opposite of the fun tech investments to go to the bread and butter of loan growth. But look, it is hugely important because this is typically what banks are all about, that they have strong net interest income. And of course, we haven't seen it because rates have been low. Consumers have a lot of liquidity. They don't need to take out loans. So this past quarter, what we've heard so far, it's been pretty muted, but executives are very, very hopeful. We have numbers from the Fed as well. That's what we're looking at here, that have shown an uptick in loan growth in the past few months. So it is likely to get better, but I have to say, from what we've heard so far, the fourth quarter of 2021, still pretty muted.
Yeah, to be fair, for the record, let the record show they didn't poo-poo it. I thought it wasn't the best dinner party conversation to talk about the 12 billion, but maybe I stand corrected. What are they spending the 12 billion on?
Well, look, they have a lot of competition when it comes to the digital space, because it's not just the big banks they're competing against. They're competing against the Apples of the world. They're competing against buy now, pay later firms. So they need to invest really in these types of different digital banking technologies to just keep up with the times, frankly.
Yes, exactly. Keep up with the times. Invest in technology, not dinner party. Fran was like, if you start talking about that at a dinner party that you invite me to, I'm walking out. It's basically what Fran said.
I didn't exactly say that. I said, if that's the best banter we can have at dinner party, I need to be invited.
She may have a point on that.
There's no way loan growth is more exciting, though.
I mean, I was going to talk Djokovic, but okay.
That is more exciting.
Yeah, the French Open. Hey, look at these markets now. Okay, the stock 600 down more than 1%. Turning into a bit of a bloodbath as we adjust to these higher yields. Technology down almost 2%. Energy is the one sector remains in the green. Okay, coming up later today, we're going to speak to the CEO of Standard Chartered, Bill Winters. That conversation is at 1:30 p.m. UK time. Stay with us. This is Bloomberg.
wonder how all that chocolate makes it to the supermarkets in time for Christmas. I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kat, toffee crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. So this Xmas is its first big test, and so far, it looks like things are going well.
From New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into European trading day, and here are your top stories. Bonds battered, Treasury yield surge with the 2-year topping 1% for the first time since early 2020. Oil markets roiled. Brent hits a 7-year high as drone strike on Abu Dhabi sparks tensions and accusations fly once again. Boris Johnson's former top aide, Dominic Cummings, accuses the Prime Minister of lying to Parliament about rule-breaking parties. Tom, it's a big market day, actually. We're seeing a repricing, of course, of treasuries, a flattening of the yield curve, and then we're on German 10-year yield watch that could touch 0% and have an impact on equities.
Yeah, and it's accelerated selling as a result of what we're seeing in those yields. Across the benchmark, European stock 600, losses of more than 1% now. Energy remaining the only sector that is in the green, given what we've seen in the run-up in oil prices. Goldman Sachs with a call for $100 by the third quarter. But let's look at these indexes then. You've got the DAX down more than 1.2%. A similar picture over in the CAC 40. Losses of 86 points over in France. And the FTSE 100, relatively, this is all relatively, supported by that higher oil price. But still, losses of 0.7%. Within the UK, Fran was just reminding me during the break that there are reports that the UK may get rid of this mandatory quarantine period for those who test positive at some point in the next few months. All sorts of implications there. The politics of the UK as well in focus, and then more broadly the geopolitics given that attack on the UAE by those Houthi rebels, and then again that playing into the oil price. Let's move it on and have a look at how things are playing out sector by sector then. It is the front end, as Fran was saying, in terms of the yield space, where you've seen these stronger moves quite pronounced yesterday, and there's flattening of that yield curve as markets strive to price in just how hard and how fast the Fed is going to go to tackle inflation. Energy remains the only sector that is in the green, up almost 0.5%. Right at the bottom of the list, technology down now 2%. That is the picture, of course, as we weigh up these higher yields. Will this be contained going forward? Fran?
Look at that. Energy, so lonely. The only one in the green at the moment in terms of sectors. Now, European finance ministers meeting in Brussels today, again, amid an energy crisis and surging levels of inflation. Now, 3 of the key new faces commenting on challenges that Europe is facing.
Now it's the time to build up fiscal buffers again. We need resilience, not only in the private sector, but in the public sector. And this is why I'm very much in favor of reducing sovereign debt.
Am I concerned about inflation? Obviously so, because purchasing power of the individual citizens will be affected, and the continued spike in energy prices is directly impacting, obviously, purchasing powers, but we need to look beyond.
We have to get back to the stricter rules in the Stability and Growth Pact.
Our Europe correspondent, Maria Tadeo, joins us now from Brussels. So, Maria, of course, the focus is on energy prices, and the focus also is on taxation.
Yes, and Francine, the focus today, as you say, very much on energy prices. Every finance minister that I've spoken with today and yesterday highlighted that is an issue that really concerns them. We know what it means when it comes to the energy component. We know what it does to household bills, and we also know what it does to companies. Just take a look at EDF, that stock is still reeling from that decision to lower prices to consumers. Now, I also spoke with Commissioner Paolo Gentiloni, who is, as you know, in charge of economic affairs for the European Union, and he also told me that it really is energy that they believe is the main driver for inflation, and also conceded and sounding to me like someone who's about to revise his forecast, saying, yes, the factors that are pushing up inflation will fade, but probably not as soon as we expected. So perhaps hinting that in just a few weeks' time, when the European Union updates their forecast for this year, perhaps they're going to also lift their inflation again, bringing up this debate as to what is temporary and how long can you say inflation is temporary.
Okay, Bloomberg's Maria today on the ground in Brussels for that Eurogroup meeting. Thank you. Joining us now is SocGen's chief economist, Michaela Markusson. Michaela, how are we starting to think, how are you and the team at SocGen thinking about these changing inflationary dynamics, how prolonged they're going to be, and whether indeed a shift to a more hawkish stance from these central banks is actually going to have an effect in bringing down these prices?
Well, I think it's very important that we distinguish the causes of inflation here. So, to my mind, there are three different things going on. First of all, there's the energy price story. And to my mind, it's going to be very challenging for the ECB, or for that matter, any central bank, to really address that issue, which is external, exogenous to their economies, by, at this stage of the cycle, increasing interest rates. So I think in terms of the energy prices, in the short term, the right thing for central banks to do is to look through this. And in the longer term, we really need to think about our energy transition, and the key word here being the transition. So this is my first point. The second issue on the inflation side links into the various supply frictions that we've seen globally. And I think these will be resolved over the coming 6 to 18 months. And this is also what we see from various forms of survey data. Again, we can question whether central banks should really respond to this. And then there's a third element, which I think is really where we see the differences on both sides of the Atlantic, is that in the US, there was a much larger fiscal stimulus, which boosted household incomes and led also to a strong demand-driven inflation. Now, we have seen some demand-driven inflation in Europe as well, linking into the fast restart. But again, this is not something permanent. So when I add all these factors
is it possible?
up, sorry.
Yeah. No, is it possible that we're importing inflation from the US, though?
So I think this is a good point. I think that what's been going on in the US is having an impact globally on inflation. So I think there is spillover. But the point I would make on the US is that much as I think it would be right for the Fed to start preparing to tighten, I think one of the issues the Fed needs to be mindful of is that the fiscal policy is turning to a fiscal headwind as we move through 2022, simply because we're not getting those same effects. So there may still be some carryover from the old stimulus, but as that fades, we will see a slowing on U.S. household incomes relative to what we've seen over the past 2 years. Now, the other factor that I think we really need to consider in the U.S. in particular are also the labor market dynamics. And what we're seeing is that the fear of a wage inflation spiral doesn't seem to be materializing quite as aggressively. And in fact, my concern is that if energy prices remain very high, we could actually see disappointment on U.S. consumption moving into next year.
Michaela, we're also getting lines from the PBOC just in the last hour or so. Obviously, the inflationary dynamics in China are very different. It offers them the opportunity to increase support for that economy. The PBOC is saying they're going to roll out more policies to stabilize the economy. Do you start to factor that in as potentially a bolster or a booster for the Eurozone picture when it comes to the economic outlook?
Well, I think what we're seeing in China is that the Chinese authorities are managing a delicate balancing act here. On the one hand, trying to avoid having an excessively leverage-driven growth model, so trying to tame in some of that leverage. We saw the various measures, in particular around the real estate market and the real estate sector in broader terms. But at the same time, they don't want that slowdown to come too quickly either. So there's really a balancing act going on here. So what I see from these latest measures is more a question of trying to stabilize and support growth rather than giving a new strong impetus to the economy that would seek to significantly accelerate the growth levels from here on up. So in terms of the spillover to the US and the euro area, yes, it's much better. It's a positive relative to the alternative scenario, but I don't see it as a strong impulse to growth per se.
Michaela, is there a sweet spot for Chinese growth that the world needs?
I think there's a sweet spot for growth for everyone when we look at the global economy today. But yes, I think there is a sweet spot for China, and given the relevance of the Chinese economy for the global economy, it's a sweet spot for China. It's a sweet spot for the global economy as well.
You talk about the geopolitical risks, and those have been underscored just in the last 24 hours. We were discussing at the top of the show just how numerous they are and how they have become more pronounced. How do you rank the geopolitical risks as you look at the economic implications?
So I think when we look at the various geopolitical risks, of course, the economic implications come through various different channels, but top of the list at the moment has to be those geopolitical risks that have implications for the energy market. And I think there's the short-term issues that we discussed, but I also think, again, coming back to my point, that there's a longer-term issue here as well. And this is where I think what the European finance ministers ultimately decide becomes important. It won't be a decision just at the meeting today, but I think longer-term, how Europe manages its energy transition becomes critical for how our future energy prices develop. And here it's key, as we look ahead for the outlook, to see the next generation EU be rolled out quickly. This is really what I'm watching now, is the speed of rollout for those energy investments for the future.
Michaela, thank you so much. As always, Michaela Markussen there, Group Chief Economist at Societe Generale. Now, coming up, 2021, a record year of profits for the shipping industry. Earnings expected to stay elevated well into 2022. We talk about cargo ships. It's a fantastic story. It's up next. That's the Big Take. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the tests strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Is an open question as to whether or not Omicron is going to be the live virus vaccination that everyone is hoping for, because you have such a great deal of variability with new variants emerging.
Well, part of my conversation there with Dr. Anthony Fauci yesterday, I have to say he wasn't as optimistic that we could see the end of the pandemic. He says, look, there are variants. Once again, he urged everyone to get vaccinated. But it was funny, it was with other 3 virologists, and it was amazing whether you're a vaccine maker or a virologist in tropical disease, for example, you know, your outlook is slightly skewed.
Yeah, and we had that data, the study out of Israel, suggesting that a 4th shot, its initial stages, is not that effective in terms of reducing the impacts of Omicron. And you were talking earlier, and we were mentioning this, the fact that the UK is now adjusting its policy, looking to adjust its policy around holding people and making people stay at home. That may change even if you're infected.
I mean, that's a big deal. This is according to The Guardian. So basically, they say, look, we could scrap the mandatory isolation if you test positive. And we were joking, not so joking, we're not sure what that means for a travel policy if you're a UK resident.
Yeah, do other countries start to get a little bit more cautious again about UK travellers if we haven't been quarantined, even if we've been infected? Anyway, that is, of course, what is happening when it comes to Omicron. The cases remain very high, but of course the rollout of the vaccines continues. We are currently, of course, 44 minutes into the trading day here, and the losses continue across the benchmark stocks. It's run down more than 1%. Let's get the first word news now with Laura Wright. Laura.
Data from an Israeli trial suggests a 4th dose of the Pfizer-BioNTech vaccine is not sufficient to prevent infection with Omicron. According to preliminary findings, the vaccine did raise antibody levels, but that only offered a partial defense against the new variant. However, those infected in the trial had only slight symptoms or no symptoms at all. Organisers of the Beijing Winter Olympics, which start in less than 3 weeks, say they won't sell tickets to the general public. Instead, select groups of spectators will be invited to attend and will be required to follow strict virus protocols. Meanwhile, Beijing residents are being urged to wear masks and gloves when opening overseas mail as authorities try to trace a local Omicron case. The Bank of Japan is keeping negative interest rates while adjusting its view of inflation risks for the first time since 2014. The move suggests the world's 3rd largest economy is not immune to the price forces prompting other central banks to unwind stimulus. With energy costs surging, the Bank of Japan nudged up its inflation forecasts for the year, starting in April and for the following year. The US and its allies are reported to have dropped the idea of unplugging Russia from the SWIFT international payment system if it attacks Ukraine. According to Germany's Handelsblatt, the nations involved believe the move could destabilize financial markets. They're also said to be concerned it could spur the development of a new non-Western dominated payments infrastructure. EDF has been hit with a credit rating cut and was warned over further downgrades. That's after the French state-controlled utility was ordered by the government to sell more power at a steep discount under action to tackle Europe's energy crisis. EDF plunged on the plans, which could cost it as much as 8.4 billion euros. That's the Bloomberg First Word News, Tom Francine.
Laura, thanks so much. Laura Wright in London. Now, time for our Bloomberg Big Take. It's been a record year of profits for the shipping industry, and earnings are expected to stay elevated well into 2022. Economists are also warning that persistently high prices for transportation and logistics globally are stoking inflation and clouding the recovery. Well, joining us for more on this is our Bloomberg trade editor. He's Brendan Murray. Brendan, first of all, it really brought home, you know, when we had that, I would say, logjam in the Suez Canal, that, you know, how important these things actually are. Ocean shipping remaining elevated. Is it going to get worse because there's still the zero tolerance COVID policy in China?
It could possibly get worse, but most analysts expect it to stay basically the status quo through much of this year, and it could even worsen if, as you said, the ports in China start, shutting down or restricting workers. So we're looking at ocean freight rates that have been very high. They've come down recently a little bit, but they're basically supposed to stay pretty elevated for the next 6 to 12 months.
How do those rates then, Brendan, plug into the broader macro picture in terms of inflation?
Right, so a Fed economist economist who we spoke with said that for every 15% increase in shipping rates, that adds a 0.1% to core inflation. So if you look at rates now, they're 150% above what they were just a few years ago. So we're looking at not an insignificant impact on the prices that you and I pay for things at the consumer level.
Yeah, and of course these are like our sofas, they're like our motorcycles, everything that we use, our gummy bears, which would be probably the ideal container for Casalacqua. Is there anything that regulators can do to nudge this market back to normal?
Not variations for the big container companies to sort of cooperate on trading routes. They operate much the way airlines operate, with code sharing. So there's some questions about whether competition is as robust as it could be, but there aren't that many regulatory tools to come in and actually affect the prices that companies are paying.
Okay, Brendan, thank you very much indeed. Brendan Murray. The key takeaway from that is an image of Francine on a motorbike eating gummy bears. That's with the wind in your hair.
This is like the new psychological test. Like, tell me what ideal container you would have, and I'll tell you who you are. We're going to ask Brendan of the break.
We have the package there. Brendan, thank you very much indeed. All right, coming up, accusations fly. Oh dear, Prime Minister Boris Johnson still in hot water. Former top aide accusing the PM of lying to Parliament over his involvement in a rule-breaking party at Downing Street. More on that next. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 52 minutes into your European trading day. We are down by more than 1% across the European benchmark. The one sector that remains in the green is energy. Brent prices remain elevated after that attack in the UAE. Technology down more than 2%. This is all, of course, linked to what's happening in the yield space. 1.83 for your US 10-year. The front end, though, is what is squarely in focus. Breaking above 1% is the US 2-year. We're also keeping an eye on the Bund as well to see when that crosses zero. Not quite yet, but of course, implications for the ECB on that. That is shape of play in terms of your markets then. I'm going to switch focus to what's happening here in terms of the politics of the UK. Prime Minister Boris Johnson's former top aide accusing the PM of lying to Parliament over his involvement in a rule-breaking party at Downing Street. Dominic Cummings said he would, quote, swear under oath that Johnson allowed the May 2020 drinks gathering, which took place at the height of lockdown during the first wave of the pandemic. Joining us now is Bloomberg's EMEA News Director, David Merritt. David, does Cummings' intervention then put the final nail in the coffin for Boris Johnson? How significant is this from a disgruntled former aide?
Well, quite. Disgruntled former aide is the key thing, where this attack is coming from. You know, not many fans of Dominic Cummings in the Conservative Party, potentially not amongst the public at large. Remember, this was the person who, back in that first lockdown, excused himself for driving around the north of England with his family, saying he was testing his eyesight. So I think, you know, he's not necessarily the best person to put that final nail in the coffin. But of course, he has been behind many of these leaks and many of these allegations of wrongdoing. And he was there in the building. I think we're going to have to see who else comes out and perhaps corroborates this claim. He talked about other people who were in the room, as it were, with those warnings for the Prime Minister. We've had other reporters over the last few days saying that, no one else going on the record, though. So we're still in this kind of holding pattern at the moment as we wait for this Sue Gray report into exactly what happens. But of course, Mr. Cummings' intervention kind of keeping the story alive, as it were, drip-feeding more allegations. Who knows? Maybe we'll be here tomorrow talking about the next one coming out overnight.
I'm sure we will be. I have to say, with like enemies like that, who needs an opposition party in the UK? Look, so we had various Boris Johnson apologies as well. And this is maybe a very Italian question, but we talk about the UK Tory party rage. Is it a rage, or is it kind of they're just asking questions? Is it simmering?
The rage was certainly real over the last few days. You know, our reporters at Westminster talking to many, many MPs. There is genuine anger. They've spent the weekend and yesterday, of course, gathering intel from their own constituencies, and many of them coming back to Westminster reporting that people are genuinely angry. And the polls reflect that, of course, as well. Many, many people who voted for Boris Johnson back in 2019 gave him that big landslide victory, now saying they want him to go. It's not quite at the overwhelming stage, though, at this point. You know, a lot of people still sitting on their hands, waiting and seeing. The cabinet, crucially, falling into line. You know, let's keep an eye on Rishi Sunak, the Chancellor. He's been pretty invisible the last few days. Is he just biding his time to see which way the wind blows? He's not exactly been out there on the airwaves backing up the Prime Minister. But for now, everyone is holding the line, and we're going to probably see this, you know, continue to play out.
So Liz Truss and Rishi Sunak seem to be the two people to watch in terms of potential contenders. But
yeah, and I found it amazing actually when there was that apology to Buckingham Palace. I mean, I've never seen anything like it. That felt like, you know, his time was up, and then he managed to claw it back.
Yeah, I mean, when it comes to that kind of offence to the monarch from a Conservative Prime Minister, I mean, it's quite startling. But in terms of contenders, just briefly, you're saying that Sunak's keeping a low profile. Liz Truss, one to watch as well?
She's clearly one to watch as well. Yeah. She's made no secret of the fact that she has ambitions for the top job. Other names now emerging as well. Penny Mordaunt, Trade Minister, you know, other backbenchers, of course, you know, somebody like Jeremy Hunt, who ran against Boris Johnson for the leadership after Theresa May stepped down. Many people will come out the woodwork, I'm sure, as and when the moment comes. But for now, it's pure speculation. We're going to have to see how this week really works out.
Dave, thanks so much. David Merritt there. I have to say, UK politics, once again, kind of giving Italian politics a run for their money.
For now. Let's see what happens with Mario Draghi. Okay, we're going to check on your markets then. The European stock 600 down 1%. The future stateside looking to losses of 0.9%. Your US 10-year yield is at 182. The 2-year still holding above that 1% level. And we keep across the Bund space as well. That is the shape of play in your markets. The European market opens surveillance. That's up next. Stay with us. This is Bloomberg.
lot of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
Major developed countries should adopt responsible economic policies, manage policy spillovers, and avoid severe impacts on developing countries.
Given the type of technology that is associated with cryptocurrency, we will need to have a collective approach.
It's an open question as to whether or not Omicron is going to be the live virus vaccination that everyone is hoping for.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks and futures fall. Treasury yields surge. Investors prepare themselves for Fed rate hikes to quell high inflation. Oil markets also roiled. Brent hits a 7-year high as a drone strikes on Abu Dhabi sparks tensions. And accusations fly. Boris Johnson's former top aide, Dominic Cummings, accused the Prime Minister of lying to Parliament about rule-breaking parties. Now, has distrust in institutions also become the new default on global mindset? Well, this hour, we discuss all of this with Richard Edelman, Chief Executive of the world's largest PR firm, Edelman. Send in your questions on IB Plus TV Go, or you can tweet me directly. But first thing is first, because we're seeing a market correction, certainly when it comes to some of the things that we're seeing in terms of fixed income filtering through, a possible correction when it comes to equities. If you look at European equities, down some 1%, they're all in the red, apart from energy. Now, energy is still gaining. This is thanks to Brent crude, but we spoke to many experts and analysts this morning. If you have a geopolitical tension like that drone hitting the UAE, it's something that could actually be short-lived, because if you look at fundamentals in the price of oil, they seem to be pretty much calibrated to perfection in terms of what Omicron does to demand, and then OPEC Plus could still step in. The Nasdaq Futures, now when they opened about an hour ago, is one of the things that we're watching the most, because, of course, yesterday they were closed down some 1.5%, and that could filter through some of the other fixed income space in Europe. But look at that. We're a whisker away from that 0% on the 10-year German bond yield. It's pretty significant because it's a psychological level when they're no longer negative. And, of course, now we look at swaps, and they're pricing in 4 interest rate hikes for the Fed this year. You can see the UK. This is a story about differentials. We're also seeing a lot of economists saying that when you look at what the Bank of England has done, one of the first major central banks to raise rates, they could do so again in the coming months. The CAC 40, the DAX, down some 1.1%. So U.S. Treasuries slumping across the curve, with the front end leading the decline. The 2-year Treasury yields rising above 1% for the first time since 2020. Well, investors betting that the Fed will tighten policy faster than expected. We're now joined by Janet Henry, Global Chief Economist at HSBC, and by our Markets Editor, Christina Aquino. So thank you both for joining us. Janet, when you look at some of the repricing in Fed expectations, how volatile could these price actions be on what the Fed could do? What is the data point that you're waiting for to be absolutely certain of what we're looking at this year?
Well, I think we have a firm idea, really, of where we're going over the course of the next couple of months. Even before the latest spike in the oil price, we thought that, we would be seeing inflation edge a little bit higher in January and February. I think we've had a very strong steer from the Fed. Obviously, they're going to halt the QE by March. And since December, we've been looking for the first rate rise to start in March. And no matter what happens on inflation, I think the initial moves from the Fed are still only going to be 25 basis points. So really, it's a matter of what happens over the course of the next few months in relation not just to headline CPI prints, but what happens in financial markets, and in particular, what happens in labor markets. Clearly, we've seen a shift from the Fed in recent months. Yes, they've got a dual mandate, but really inflation's the dominant concern from here. Their own credibility is in question, and it's the wage price spirals, the fear. But for the next couple of months, I think we know where we're going.
Janet, very quickly on inflation, if it's higher than expected or more entrenched, how do you expect Fed policy to adjust? Could we see a bigger interest rate hike? Could we see it, if not sooner, more hikes, but still at 25 basis points?
I think we'll see how the year evolves. I think Powell has been very clear that the inflation that the US has is not the type of inflation they envisaged when they first shifted to an average inflation targeting regime. And it was certainly before the big fiscal stimulus, and that, like many of us, they underestimated the scale of the supply disruptions that were pushing up inflation globally. But their fear will be not just the level of inflation and what it means for expectations, but this risk of a wage price spiral. So yes, if they've got it wrong, and we're starting to see signs from that, then yes, it could be more rate rises. But I don't think it's just about rate rises. Remember, it's the balance sheet. We're looking for 3 rate rises in 2022. We've been looking for that since mid-December, and the beginning of the scaling back of the balance sheet. It could just be that they accelerate further the planned scaling back of the balance sheet and move it a little bit earlier. It's not just all about the rate rises, or indeed the incremental size of the rate rises.
Janet, let's also bring in our Markets Editor, Christina Aquino. And Christina, I guess when you look at some of the repricing in terms of treasuries, I mean, you could argue they still have a long way to go.
Absolutely, Francine. I think really what we're seeing now is just kind of a return to that idea of normal policy. It's not even necessarily kind of taking into account the potential Fed tightening cycle that we're about to see here, And so, yeah, there's really also other factors that kind of counterbalancing this surge higher in Treasury yields. We've spoken a lot about kind of the long-term structural factors that are keeping a cap on yield, and in fact, potentially will still keep them under that Fed terminal rate, that long-term neutral rate that really achieves the balance between growth and inflation. But I think really now it's very much the focus on, again, like Janet was saying, both the pace and also the aggregate size of tightening that we're going to see from the Fed, both from the rate hike side of things as well as the balance sheet runoff side of things.
So, Janet, what can you tell us about the labor market in the U.S.? Again, I don't know whether there's a shift because of the pandemic where it goes back to something that we've seen in the past, or whether this labor market is just changed forever.
I think there's probably elements of the labor market that have changed forever, but I think there are certain elements of the labor market that will normalize. They're just not going to normalize overnight. A bit like some of the other supply disruptions, and perhaps more so, it could take several years to get back there. We know that more people have left the labor force, but they have still been more concentrated amongst older workers than certainly younger workers. And as much as we're seeing a surge in new business formation, some changing priorities amongst people, and of course, people making alternative means of income, some of those may actually be a little bit more permanent. But some of the older workers, it will be interesting to see how it evolves. It's not just that people are retiring earlier, it's a lot of older workers actually haven't returned to the labor market in new roles, and over time, many of those may start to come back.
Christine, in terms of the markets, we're also on German yield watch with a 10-year possibly touching 0%, which again it's not a huge move, but actually psychologically it's quite big. Could we be importing inflation from the U.S. to Europe? What are the dynamics for sovereign bond yields?
Well, Francine, yeah, it is a momentous moment, despite the fact that it's mostly symbolic. But no, I think in the question of kind of importing that inflation, Europe has plenty of inflation to deal with on its own. We're talking, of course, about the euro area's own CPI measures hitting those milestones similar to what we're seeing in the U.S. And then, of course, here in Europe as well, we have the energy crisis to deal with, which has really not gone away. And so I think there's very much Europe's own factors that are driving up inflation and feeding off of the broader inflation environment.
And of course, Janet, this has huge implications. I mean, when the Fed starts normalizing, it has huge implications for emerging markets. So, how much time do you spend looking at what that means for that part of the world?
No, we look at that, but we look globally. I think, we've seen emerging markets raise interest rates quite aggressively, certainly in CEMEA and Latin America through the course of 2021. And we've seen little or nothing out of Asia so far. And I think some of those Asian economies will be gradually starting to tighten in 2021, but they really stand out globally. There are very few economies in the world where inflation is below central bank mandates. Japan and China are two of them, but elsewhere in Asia, inflation is much more subdued, not least because the consumer recovery has been less strong. But for the emerging economies, I think it's a familiar story. They always tend to be vulnerable to any disruption in the price or availability of capital flows when the Fed is starting to tighten policy. So anyone that's got imbalances, anyone with large budget deficits or reliance on capital inflows to finance their current account deficits, then they are going to face some disruption. A lot of them think they've got a little bit ahead of the curve. Arguably, some Latin American countries like Brazil did move a little bit earlier this time. That should make them a little bit more prepared. But anywhere where they're a bit behind the curve, then they are more likely to be subject to a lot more disruption as the Fed continues and possibly accelerates the tightening.
Janet, thank you so much. Janet Henry, their HSBC Global Chief Economist, stays with us. And thank you as well to our Bloomberg Markets Editor, Christine Aquino. Now, coming up, China's economy grew at a strong pace of more than 8% last year, despite a crashing property market and a crackdown on big tech. We have that story next. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, China's economy grew at a strong pace of 8.1% in 2021, and that's despite headlines from a crashing property market and a crackdown on big tech. President Xi Jinping says he's confident in China's economic future.
The fundamentals of the Chinese economy, characterized by strong resilience, enormous potential, and long-term sustainability, remain unchanged. We have every confidence in the future of China's economy.
Well, let's get straight to Janet Henry, Global Chief Economist at HSBC. Janet, a lot of questions about what the PBOC can and will do and whether they're going against the grain by putting monetary policy that's much more accommodative compared to the rest of the world, and whether that actually benefits the rest of the world or whether we should worry more on the growth side.
Yes, that's right. I mean, you're right. China is obviously the single biggest driver of global commodity demand. And if we think about every slowdown in China over the recent decades, it's had a massive impact on the global economy. But I think as far as China's concerned, you mentioned that 8.1% figure, and actually the fourth quarter GDP figure, if anything, came in a little bit stronger than expected. But some of the more recent data, because obviously yesterday we got the December data, does make it clear that there are some areas that were already slowing down. Property has not had the kind of free fall that had been feared, but property sales have actually been falling. The consumer recovery continues to disappoint, and with the latest round of restrictions related to the rising COVID cases, etc., that means that's likely to remain weak in the early quarter. So we have seen this change in stance from the PBOC. So, it has been about starting to at least stabilize what's happening to credit availability and price, and try to stabilize the slowdown in activity and support some improvement as the year progresses.
Janet, when you look at China's property sector, right, the contraction was a little bit worse, of course, than expected, and that's hurting the economy as a whole. Will it get worse? Is it a worrying sign that we should pick up more, even more than GDP, or do you think it'll stabilize?
I don't think it's going to be a major driver of GDP. I see an evolution of the growth story. As I say, Chinese property sales did fall, and in fact it got worse in December from November. I think there are signs, though, that it is starting to bottom out, and as credit availability and price to households improves, we may see some underlying demand. And then as the year progresses, you may even see some stabilization in construction activity. But remember, China's broad policy mix isn't just about the price of money. And if anything, they haven't, they probably will cut tomorrow the loan prime rate, but much less so for the 5-year. They don't want to reignite property speculation. They want to support infrastructure spending, which I think will revive on the back of local government bond issuance. And in particular, they want to continue to support manufacturing investment and, of course, green investment. And that's where more of the growth recovery can be expected to come from as 2022 progresses.
Janet, what are you expecting here in the UK? So, by speaking to traders, they say it's probably one of the most unpredictable major central banks, and we don't really know the effect of quantitative tightening. And, it could be very interesting given the uncharted territory of this.
Yes, it could be interesting because really it's going to be the first major central bank to do it, given the intended sequencing of their guidance. So certainly in what we've seen on the labour market data, no doubt what we'll see in the inflation data, tomorrow means that they are on track to raise rates again in February, and that means that the quantitative tightening will begin in March. Now, that's just a one-off redemption, but it is, a significant one. And then we expect them to continue the tightening. In fact, we think the Bank of England will deliver all of its tightening in 2022. So it will give us the first steer. But remember, there are other central banks globally that will have a bigger impact in terms of global financial conditions. So I think it's not going to have a massive impact on the UK, maybe a little bit on the currency.
Yeah, Jen, I was going to ask you actually. I don't know whether we want to call it the QT conundrum, but can other central banks look at the UK and replicate, or because of just the composition of the UK economy, it's very difficult to see what kind of impact they would have elsewhere?
Yes, absolutely. The UK is unique in many ways, and the stock market isn't necessarily directly related to the shape of the UK economy. But also at the moment, as far as the UK is concerned, we don't know how much of the different mix within the economy is related to COVID-19 and how much is related to Brexit itself. We know, for instance, it's not just what's happening in the consumer side, which has been the major driver of global growth in the advanced economies in particular. The UK has massively underperformed on the export side. We have to assume at least part of that is related to Brexit. So I think, yes, it's interesting to watch, and there may be some feed across, but the UK and some of the challenges facing the Bank of England are somewhat unique compared with, for instance, the ECB or indeed the Federal Reserve.
Janet, thank you so much, as always, for joining us. Janet Henry there, Global Chief Economist at HSBC. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. Data from an Israeli trial suggests a fourth dose of the Pfizer-BioNTech vaccine is not sufficient to prevent infection with Omicron. According to preliminary findings, the vaccine did raise antibody levels, but that's only offered a partial defense against the new variant. However, those infected in the trial only had slight symptoms or no symptoms at all. Organisers of the Beijing Winter Olympics, which starts in less than 3 weeks, say they won't sell tickets to the general public. Instead, select groups of spectators will be invited to attend and will be required to follow strict virus protocols. Meanwhile, Beijing residents are being urged to wear masks and gloves when opening overseas mail as authorities try to trace a local Omicron case. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thanks so much. Coming up, we'll be talking U.S. banks ahead of Goldman Sachs earnings a little bit later today. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's talk about banks, but also the Nasdaq Futures sell-off seems to be gathering pace as these bond yields are climbing. So the stampede out of these expensive technology stocks may be far from over as bond yields are on the move. If you look at U.S. bank earnings ahead of today, we have Goldman Sachs, we had, of course, Citi, and we had J.P. Morgan last week. Let's not confuse everything because I'm talking about bond yields. I mean, this should be supportive for banks, but then Goldman Sachs has another set of problems.
I guess the issue is for bond yields to be supportive, we need it to run a little bit further. Right. Yeah. So we're not at that point yet, but we saw both Citi and JP Morgan, as you point out, they reported on Friday, their shares fell. The issue is that 2020, the end of the year, which was the comparable, of course, for last quarter, you had this huge trading bonanza, and of course they don't have it anymore. The numbers were still strong, but not up to expectation, and at the same time, costs are rising a lot. We talk a lot about the talent war within banks. We're looking at JP Morgan's numbers right now. Their expenses rising year over year. We're also talking about their technology spend, so that's in there as well. But these problems will definitely be present for Goldman too. Not just the technology spend, but also they gave their partners from a few million to multiple millions of a payout.
But this is the war on talent.
Exactly.
I guess, I mean, as long as revenue's okay, right, or from trading, right, then they could afford to pay.
Right. Well, they need to make it up somehow, right? Because that margin gets slimmer and slimmer. So you're in a world where, okay, trading doesn't look as strong. Is loan growth there? No. Consumers still have a lot of liquidity. They're not taking out loans. But I should say banks are pretty optimistic on this point. A lot of the executive commentary. But again, this is something that's going to need to take time to play out. We're not seeing it yet.
So on fintech, I know our Tom McKenzie was obsessed with this $12 billion story at JP Morgan. I mean, is it because they're so behind, or is it looking at new cards and the way we interact with, you know, the banks on our phones instead of going into retail?
I'd say it's both of that. There's this whole new crop of fintech. Maybe it's wrong to call them new because they've been popping up for a while now that the big banks need to contend with. I have to say, though, Mike Mayo over at Wells Fargo says that there isn't enough granularity. He wants more detail from JP Morgan. So, you know, we don't know exactly what the payout's going to be.
Yeah, we certainly don't. I'm looking forward to those Goldman Sachs pre-bell. Before the close. Yeah, yes. There you go. We'll have the story for you on Goldman Sachs, and we'll put into context with a lot of the other U.S. banks. Coming up, has distrust in institutions become the new default global mindset? We're joined by Richard Edelman, Chief Executive of the world's largest PR firm, to discuss Edelman's latest trust survey. A spoiler, it's not looking great. This is Bloomberg.
energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocks and futures fall, Treasury yields surge, investors prepare themselves for Fed rate hikes to quell high inflation. Oil markets roiled. Brent hits a 7-year high as a drone strike in Abu Dhabi sparks tensions. And accusations fly. Boris Johnson's former top aide, Dominic Cummings, accused the Prime Minister of lying to Parliament about rule-breaking parties. And finally, has distrust and institutions become the new default global mindset? This hour, we discuss with Richard Edelman, Chief Executive of the world's largest PR firm, Edelman. You can send in your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the market's definitely on the move. Let's quickly go into Nasdaq Futures, where we see the most exciting moves apart from that yield. Now, the stampede out of expensive technology stocks may be far from over, as bond yields, the biggest threat for high-flying growth stocks, are actually marking a new post-pandemic high. Let's also look at what bond yields are doing, especially here in Germany. Now, it's very clear that if you look at the $1.5 trillion rout in the Nasdaq composite in the first week of 2022, that sent some of the most pricey stocks down 10% or more. The future is now pointing to a lower start, down some 1.9%. But Bunds, definitely the one to watch out for. Again, psychological level, but we're very close to that 0% mark. We're not there yet. We're still, I think, in negative territory. But as soon as it hits zero, that's certainly something that we need to watch out for, because it's psychologically just like the 2-year yield over in the U.S. touching 1%. Joining us to discuss all of the markets is our markets wizard. He's Eddie van der Veld. Eddie, I don't know whether there's a fundamental repricing or whether we'll see dip buyers, but it feels like a big markets day.
Oh, yeah, absolutely. And I think the bond market, again, just showing that it is the big dog and everybody should be paying attention. As you say, that 0% level in Bund yields, well, it'll be the first time that investors actually get paid by, German lenders since 2019 for locking their money up for 10 years. So, this is it's a very close run thing at the moment, and I do think it will have a psychological effect. We may see some follow through beyond those levels. But what's really interesting to me at these levels is that we're seeing a bit of a bear flattening, right? We're seeing the 2-year rates across the board rising just a little bit more than the 10 years, and what that means, it just shows that what traders are thinking is, yes, the central bankers are going to raise rates because they are worried about inflation, but they may damage growth. And I think that's what the traders are worried about here. And I think, therefore, we could see this run a little bit.
So I guess, Eddie, that, it's all about sequencing, and the Bank of England will be the first test because they started hiking earlier, how they get on with this quantitative tightening and what that means for the rest of the world.
Yeah, absolutely. And the central bankers will be very sensitive, to their own domestic economies with regards to how far they think and how fast they think they can go. I do think that there is perhaps a play from the central banks coming into the year where they sound ultra hawkish. And that gives them a lot of scope later in the year to deliver some dovish surprises. So if we see the stock market selling off and we see a little bit of panic set in, then the central banks could still deliver, the Fed could still deliver 2 rate hikes and look dovish. And then, you could see equities bounce back, because what really matters isn't the level of rates, it's the level of rates relative to where traders expected them to be. And I think, so I think this could actually be, this is one way or another, it's shaping up to be a very interesting year.
Yeah, it certainly is. Eddie, talk to me about oil. Continue to push higher. I know partly this is geopolitics in the UAE. I don't know whether that will be short-lived, like often is the case with geopolitical events on the price of oil, or whether there's something more fundamentally wrong here.
Yeah, geopolitical risk, unless it really blows up, tend to be very short-term events in the oil market. Now, but my colleagues on the oil team tell me that there are actually real tightness to be seen. There's actually real tightness to be seen in the oil market. We're actually seeing, producers struggling to increase their output. But I think as we go deeper into the year, what we're likely to see is we'd like to see some more shale production come on stream. And I think if prices stay as high as they are now, or push a little bit higher, I think we may see OPEC pump a little bit more too. So I think that the supply side may actually cap prices a little bit. That puts a cap on inflation, and again takes us back to a slightly more dovish policy environment, perhaps later in the year.
Eddie, I'm looking for dip buying. They're always there, the dip buyers. Where are they today?
I don't know. Where's the dip buyers? But you know what? I think one thing that's interesting is we've seen the S&P 500 pull back about 5% or so, I think 4 times over the past year. It's never gone to 6%. So we've seen it around about these levels of where we usually see the dip buyers step in. Now, I've got a big bet on with Mark Cudmore that it's going to be, the dip buyers are going to come back again this time. He thinks they're not. We shall see. I think just people have been conditioned to come back into the markets when we see these big pullbacks. And I think this is the kind of level that we usually do see them.
Eddie, what did you bet? Is this like gentleman's agreement, or are we talking hard cash? Wine?
No, pride. A lot of my pride is on the stake here.
All right. I love, actually, that Larry Fink wrote his annual letter to chief executives. And this is a quote that really stuck with me, because it's not often that we talk about being woke or not woke when it comes to some of the things that shareholders are looking at. So this is the quote. He says, stakeholder capitalism is not about politics. It's not social or ideological agenda. It is not woke. Is everything now being politicized, Eddie, up to how we save the planet, but also maybe how markets move?
He's hitting on a really important point there, because, a couple of years back, it was a truism in markets that you kept your politics and your money separate. Your portfolio wasn't decided based on what your political views are, right? You didn't invest in the US because you didn't believe in a Trump presidency or in anything else. You put your money where you think the growth was. Today, investors are a lot more willing to put their money where their principles are. Investors are much more willing to take those principled bets and say, listen, I want the world to be more ethical and more green and more, various other things, and they're willing to invest that way. And I think, money managers are feeling the pressure from the people who allocate money to follow suit. So I think this is something that will reverberate across markets. Fink's onto a big thing here.
Eddie, thank you so much. Eddie van der Veld there, our markets guru, never dull. Coming up, has distrust in institutions become the new default global mindset? We're joined by Richard Edelman, chief executive of the world's largest PR firm, to discuss Edelman's latest trust survey. Usually, it's a pretty shocking read. That's coming up next, and you can send in your questions on IB Plus TV Go, or you can also tweet me directly on Twitter. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, distrust in institutions has become the default global mindset. That's certainly one of the key findings of Edelman's 2022 Trust Barometer survey. Edelman, the world's largest PR firm, found that a growing majority of people believe they're intentionally being misled by journalists, business leaders, and governments, while businesses continue to be the most trusted institutions. Well, to tell us more about the findings of the survey, we're now joined by Richard Edelman, the chief executive of Edelman. Richard, always great to speak to you, but it is so depressing. How do you regain that trust? If people don't believe that the government is out to make or try and give them at least a better life, and businesses don't do the same, how do you bridge that gap?
I think the big word is competence, Francine. The reality is we have a moment in time when business is 50 points more trusted than government about getting things done. And there's no ideological constraint. There's no business just has to operate effectively, whereas politics has impeded government's ability to do the same. And so if I'm in business, I now have 5-to-1 people saying, I want more business involvement in societal issues, whether it's reskilling or sustainability or curing the pandemic or wage levels. And business has to fill this void that's left by an incapacitated government.
I mean, that's all well and nice, but a lot of businesses actually need government support, right, for regulation and other things if they want to get things through. Is there a misnomer that businesses do things better?
Look, I think that the moment we see a real decline in trust in democracies. The single-party states have done very well this year, but in the democracies, under 40% of people believe that they'll be better off in 5 years. It's an economic issue. It's also 85% said in our study that you actually have a fear of job loss. 75% are concerned about the climate. And so the pressure at the moment on CEOs, 80% say, I want CEOs to stand up and speak up on our behalf. Why is this? Because you want employees who buy into the theory of your company. You also need to have consumers who are belief-driven buyers. And now the new phenomenon is, as Eddie just said, 88% of financial institutions rank ESG equal to operations and financial performance in buying a stock.
Yeah, I have to say, Richard, again, at 61%, business, as you say, is the most trusted institution. But also, I don't know whether it's just that governments are so poorly rated rather than businesses doing so well. I mean,
but Francine, there's a real warning signal.
Yep.
There's a real warning signal here for business, which is in the United States, the trust in business among Republicans dropped 12 points. Republicans trust business less than Democrats for the first time. And also, there's a big issue around fairness. And the so-called crisis of capitalism is real. More than half the people in our study said, I don't think capitalism is a force for good. So there is a logical extent to which business can go. And I think CEOs have to be careful to stay in their swim lanes, that, you are able to do climate or you are able to do wage levels, but careful, don't do this without government. You have to have a playing field that people understand. You're not elected, you're not appointed.
Right, and it could also, in certain cases, backfire. And I guess, Richard, there's a difference between the listed companies and the non-listed companies, because the listed companies also have a duty of care to shareholders, and that may not be for the greater good.
But I also think that there's this very vicious cycle of distrust between government and media that has to be broken, because the business model of media, not Bloomberg, but others, increasingly is chase clicks. And on the government side, it's to go for division. And this, basically what you have is this death grip among the government and media, where it's circling downward. Because between division and disinformation, you have people, actually 2/3 saying that our leaders are liars and they don't believe in the truth in media. So the number one thing that increases trust in institutions is information quality. So every one of us has to tell the truth and get facts out there.
Richard, let's go back to business, and then I want, this idea of trust, it's actually quite difficult to define, but, respondents also believe that businesses are not doing enough for climate change, inequality, information, trustworthy information, but also workforce reskilling. I mean, some of them are big deal that you can't do them without government support, especially the reskilling part.
Well, again, we're going to have between 400 and 800 million people potentially lose their jobs to automation in the next decade. In retailing, financial services, you already start to see this. So I think that is the greatest opportunity for regaining trust between the business sector and government. Take this on as our responsibility in the next few years and show serious and tangible progress. What people want is for a sense that the system is working, and business has to be the jumpstart right now. Government gave support in the wake of the pandemic, and government scores, literally 18 months ago, government was the #1 trusted institution, the only one big enough to handle the crisis of the pandemic. Government trust can rise if the pandemic is well managed in the next 6 months. And I believe that what we have right now is a very unbalanced institutional framework where business is at the top and media and government are at the bottom, and that's like a seesaw in the playground. It's unbalanced. Kids aren't going to have fun if you can't go back and forth.
Yes, it's true. I've tried that, myself before. Richard, talk to me a little bit about trust. I mean, we talk about the idea of trust, but you can be a trustworthy person if you have a campaign of misinformation against you, then people don't believe you. So is it that people, is it a perception of trust, or is it that you're actually not trustworthy?
For us, the trust definition is trust to do the right thing. Are you dependable? Are you able? Do you have integrity, and do you have purpose? And what's happened really since the Great Recession in 2008 is that ability is assumed, but it's the other three factors, dependability, integrity, and purpose, that really drive trust. And the idea of information quality is so vital at the moment because we don't seem to have shared facts, whether it's about environment or about vaccination, and you then get paralysis. Literally 2/3 of people believe that their leaders are liars, whether it's CEOs or government leaders or journalists. So, and they also distrust the channels of information. So that's why I think this information question becomes paramount in the next year of getting facts in front of people. And that means everybody part of this solution.
Richard, there's something that also really caught my attention, and it makes me worried, is basically the social fray. So the fact that people cannot have civil debates, and you say in your trust barometer that 64% of people in their country lack the ability to have civil and constructive debates. Is it getting worse, and will it continue to get worse?
So 60% of people, Francine, also come into a discussion not believing the other person. that we're in this, again, negative cycle of distrust. I actually believe that it is possible to improve in the coming year. We have to get facts in front of people. We have to tell both sides of the story, and we need to do it in a way that is less frantic. Scientists are deeply trusted. People close to me are trusted, especially my CEO, my employer. 77% trust that institution. 15 points more than business in general. So that means trust is local, and that we have obligation to talk to our employees. Employees are the key to the future of belief, because if we talk to them, then they talk peer to peer, and then we start the system working again.
All right, Richard, thanks so much. One day you're going to come on and give me good news about the trust barometer, I hope.
Next year.
Richard Edelman, Chief Executive there of Edelman. Let's hope next year. Now let's also get to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. EDF has been hit with a credit rating cut and was warned over further downgrades. That's after the French state-controlled utility was ordered by the government to sell more power at a steep discount under action to tackle Europe's energy crisis. EDF plunged on the plans, which could cost it as much as 8.4 billion euros. The Bank of Japan is keeping negative interest rates while adjusting its view of inflation risks for the first time since 2014. The move suggests the world's third largest economy is not immune to the price forces, prompting other central banks to unwind their stimulus. With energy costs surging, the BOJ nudged up its inflation forecast for the year, starting in April and for the following year. Crypto.com says it stopped all deposits and withdrawals while it investigates unauthorized activity on some accounts. The crypto wallet provider and trading platform tweeted that all funds are safe, but that security is being enhanced. Several users had recently used social media to report the alleged disappearance of funds. That's the Bloomberg Business Flash. Francine.
Thank you so much, Laura. Now, coming up, accusations fly. The Prime Minister, Boris Johnson's former top aide, accuses the Prime Minister of lying to Parliament over his involvement in a rule-breaking party at Downing Street. Well, more on that next. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick is invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company, and we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, on to the politics bit. And Prime Minister Boris Johnson is in hot water. Now, his former top aide has accused the Prime Minister of lying to Parliament over his involvement in a rule-breaking party at Downing Street. Now, Dominic Cummings said he would swear under oath that Johnson allowed the May 2020 drinks gathering, which took place at the height of lockdown during the first wave of the pandemic. Well, joining us now is our Bloomberg's EMEA News Director. He's David Merritt. David, so I looked at the tweet actually on the blog of Dominic Cummings, and the problem is that people maybe believe him, but A, he's an enemy now of the Prime Minister, and also he's not squeaky clean himself. So do people believe and trust him?
That's right. Cummings not very popular within the Conservative Party. Cast your mind back to his own confession of breaking lockdown rules and said that he was driving around the north of England with his family in the car to test his eyesight. So he doesn't have a huge amount of credibility with the public and also with the Conservative Party. He's made no secret of the fact he wants to bring down Boris Johnson. He said Boris Johnson is unfit to be Prime Minister. He's been leaking out details of these parties over weeks now. So this is the latest salvo from Mr. Cummings. Unlikely to be fatal of itself, because, as I said, everyone knows what his agenda is, and he is not a popular person in the country at large.
There you go. We have Boris Johnson not live and not actually photobombing our shot, but you know, the man that's in hot water. Dave, I guess the question is, it all depends on 20 MPs on whether this man stays or goes as head of the UK government, because it's not polls, so it's not the citizens that decide whether he stays or goes.
That's right. He's clearly not going to resign. I think he's made that very clear. So the only way for him to leave office is for his own MPs to throw him out. You know, the process is a little bit complicated, but essentially 54 of them need to send in a letter of no confidence. That would trigger a vote in Parliament to see whether he needs to stay. Of course, he could win such a vote. So there are many, many hurdles for them to get through in order for him to leave office. But there's no doubt that that dissatisfaction is growing. Many MPs, some have already sent in those letters, many are waiting, and they're saying that publicly. Let's wait and see what this official investigation being done by the senior civil servant, what she has to say. We might know this week, we might know next week. Then we might see a little bit more movement from the ground troops.
But is there a deep belief amongst, especially, you know, the right-wing party of the Tory party, that it's only Boris Johnson that can deliver Brexit, that can deliver, you know, some of the loosening things that we want in terms of pandemic? So even not making mandatory isolation once you have COVID a thing.
Yeah, of course. You know, what's happening at the moment is the numbers on Omicron are really going in the government's direction. They're talking about loosening the rules, and then if this other scandal wasn't unfolding, Mr. Johnson would be crowing about his success in managing to strike that balance between restrictions and the pandemic. But all of that is being drowned out at the moment. But yeah, you're right. You know, many people in the Conservative Party view Mr. Johnson as the only one who can stitch together this broad coalition to win. Remember, he won that huge election victory just 2 years ago, 2019. Yeah. Loads of people voted Conservative who had never voted before. Why? Because they were voting for him. And if you're a Conservative MP now, you look around the rest of the Parliamentary Conservative Party, who else is able to deliver that sort of result?
David, thank you so much. David Merritt there. Certainly UK politics more colorful than Italian politics right now. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, Anna Edwards in London. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're optimistic that by the end of 2022, we will be close to normal. The interest rate environment is probably the most important economic backdrop over the course of this year.
You have monetary policy uncertainty, you have fiscal policy uncertainty, you have economic policy uncertainty, and some geopolitical issues.
It's going to be a very challenging year for macroeconomic policy.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, January 18th. Our top stories today. Traders ramp up their bets that the Fed will raise rates in March. Two-year yields go above 1% for the first time since 2020. Meanwhile, the price of Brent oil hits its highest level in more than 7 years. Goldman Sachs is out with earnings before the opening bell today. Analysts are waiting to see if investment bank fees keep growing at a fast pace. And the best stock picker of 2021. He earned the title by betting on an industry that was at the center of the supply chain crisis. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And once again, Kaylee, welcome back to the global market fray this morning, to those in the United States, of course. And you're welcomed back with another sell-off in tech.
Yeah, and a big one at that. Nasdaq 100 futures are down the better part of 2%. I know Matt will really dive into that in just a moment. I would note, though, that the losses weren't as severe in Asia. Yes, broadly, it was a lower day. Hong Kong, Japan equities lower. The MSCI Asia Pacific Index falling about 0.6%. One notable exception to that, though, was China. The CSI 300 up about 1 percentage point. And within that, it was actually infrastructure-related stocks that really outperformed. A benchmark of those up about 4%. And that is on bets that we're going to see more fiscal spending out of China as well to help revive growth in the economy, of course, following the rate cut we got from the PBOC yesterday. And of course, while policy is getting easier in China, it is getting tighter pretty much everywhere else in the world. And that is leading to a really dramatic global bond sell-off led by treasuries, but bleeding through to the Asia Pacific. And one place that happened was in Australia, the short end of the curve, really, where we saw a lot of movement, up 6 basis points on the 2-year yield. Finally, of course, with yields moving higher, that is putting pressure on emerging Asian currencies. The biggest underperformer today was the Philippine peso, weaker against the dollar by about 0.4%. 51.47 is where it sits right now, but that is the weakest level against the dollar going all the way back to March of 2020, Matt.
All right, very interesting stuff going on in markets today, especially when you look at the U.S. futures picture. Here, S&P futures are down more than 1%, but Nasdaq futures are down 1.75% and have been down 2% today. So we're really on market alert, market watch today. This is all driven, of course, by yields, especially hurtful to tech stocks when they rise in the front end. You can see the 2-year up above 1% now. Again, the U.S. 10-year yield at 182.52. If you take a look at what's going on with oil, it's moving a lot in the other direction. So crude is up. This is NYMEX crude up 1.5%, $85 a barrel. And you see Brent crude up to 87 and change. We're looking at the highest levels in 6-7 years, really, since 2014 for oil. As the market is tight in terms of supply and demand is holding up, Omicron hasn't dented it. The Bloomberg Dollar Index, which had been coming down, remember, from 1190 in November to about 1165, is now back on the way up. And what this means is Investors are reaching to the dollar for safety. They're looking at it as safe haven. You did see a little bit of strength in the yen as well for a while this morning. The gold price is coming down, but still above 1,800 at 1809.63 right now, and Bitcoin rising just a bit at 41,889. It's really, though, Anna, all about yields and oil this morning.
All about yields and oil, all about tech selling off here in Europe as well, and not cushioned by some better data coming out. The ZEW indicator of expectations from the German economy, that showed some positivity in just the last few minutes, just crossing the Bloomberg terminal, but that hasn't taken the edge off the selling that we're seeing across European equity markets. We are red almost across the board for European equities, and it is places where we rely on technology that we're seeing the sell-off a little bit worse. Places where we have an energy component, we can show you where energy is right now. The energy sector, one of only two moving to the upside. Energy and telecoms moving higher here in Europe today, but even so, not by very much. Technology down by 2.4%. Technology stocks really weak today. It's pretty indiscriminate. Only one of the tech names in Europe moves to the upside, and that is something that operates in the cybersecurity space, so perhaps moving to its own tune there. And just to tie in with what Matt and Kaylee have been talking about on the yield story, very much the dominant theme. We're watching the 10-year German Bund. Will it get back to zero? This, of course, in negative territory right now. It keeps edging back towards zero and then pulling back from that move, as if the market is trying to test the ECB. Can you really afford to be so far behind the Fed curve as we're increasingly pricing in Fed rate hikes? And the UK 10-year gilt yield, I put that in as well because we've had labour data out today. That came in pretty strongly. We get inflation data, Kaylee, from the UK tomorrow.
All right, well, those higher yields, Anna, in theory, pretty good for the banks, but I have a feeling they're going to be moving more on earnings today than anything happening in the bond market, because when we think about what's ahead today at 7:30 a.m. Eastern time, we will get earnings from Goldman Sachs. Of course, this follows JP Morgan and Citi, which on Friday really disappointed. So what will we see from Goldman? Bloomberg Intelligence is expecting that investment banking will be a key strength in the fourth quarter. Then Bloomberg's Year Ahead conference will start with a virtual format. Speakers include the CEOs of Intel, Visa, and Cisco. And then finally, the meetings between European finance ministers continue in Brussels with the ECOFIN meeting. The focus will be on the global minimum tax. And of course, Matt, we'll talk to Maria Tadeo, who is live there in just a moment. But first, we need to talk more about these markets.
Yeah, absolutely. Let's get to our top story. As I said, we're really watching yields this morning. Treasuries falling across the curve with two-year yields soaring above 1% for the first time since 2020. Meanwhile, Brent oil extending gains to the highest level that we've seen in 7 years. There's the Brent quote. You can see we saw earlier what was going on with a WTI at 85, Brent trading at 87.31. Joining us now is Christine Aquino, who helps lead market coverage for us out of London. So, Christine, is yields what's pushing everything else around this morning in terms of risk assets?
I think that's exactly it, Matt. Where yields will go, everything else will follow. And it's potentially why we're seeing such a big sell-off in tech, of course. That 10-year yield really getting close to that 2% level that, as we know, has been widely flagged as a potential pain point for this high-growth sector. And now it's potentially coming up much faster than markets are expecting.
Okay, and the focus on oil prices also very real for markets and for investors today then, Christine. Heading up, well, past 7-year highs, levels we haven't seen since 2014. Geopolitics and violence in the Middle East once again back on our radar.
Absolutely, Anna. And I think this really makes for a potentially toxic combination for consumers and investors in this sort of environment. It's one thing to deal with higher yields and the financial conditions squeezed from that aspect of the markets, and then now to also have to deal with higher energy prices, of course, as a result of potential geopolitical risk. I think this is a double whammy that certainly will weigh on consumers in the near term.
Absolutely. I mean, oil prices off highs of the session, but still up by 1%, 87.28 on the Brent price this morning. Thanks to Bloomberg's Christine Aquino for joining us here on set in London. Now, US bank earnings continue today with Goldman Sachs reporting fourth quarter results before the market opens. Analysts are watching whether investment banking fees at the firm continue to grow at a fevered pace. Let's get more with Bloomberg's Danny Berger. That really is going to be the focus. Investment banking fees, also no doubt compensation after what we heard from JP Morgan.
Yes, exactly. It's a tricky time for banks considering that we've seen that boom in terms of trading start to cool off. So Goldman needs something like the really strong investment banking fees to help make up for that. And as you say, expenses. We've seen Goldman Sachs stock this over the past 3 months fall about 8%. But of course, banks in general so far this year are up some 11%. So a lot of valuations that they need to live up to. So expenses are rising. And I think JP Morgan is perhaps a good proxy for this, because both JP Morgan and Citi falling on Friday because of that expense picture. They saw their expenses over the year rise 8.6%. That's what we're looking at here for our radio audience. I have a chart. So as the revenue, yes, is going higher, they need it to move even higher to make up for these expenses. And we know Goldman, of course, is paying its partners millions, multi-millions as a one-time bonus. So their expense is likely to be a big focus here.
I got to ask about the drama playing out in Switzerland. It seems Antonio Orta-Ozario has stepped down.
Yeah, exactly. Stepping down. This is concerns over some COVID breaches he had. This was, of course, before the long weekend for the U.S., so we have a little bit of catching up to do. Stepping into his place is Axel Lehmann, and there is some hope, at least among bankers, some excellent reporting from our banking team, that they're optimistic because it is a message of continuity. Axel Lehmann has said he's going to continue the reforms put in place by Orta-Ozario. So even though it's a change at the top, the hope is that the reforms that Credit Suisse has put in place will continue on, because at this point, they really cannot afford another scandal. Of course, shares fell on Friday, on the news, on Monday as well, I should say. And Citi analyst Andrew Combs writing that this could potentially throw into question leadership at the bank. So certainly a lot of work for Credit Suisse to do now.
Yeah, just one hit after another. Thank you so much to Bloomberg's Danny Berger. Now let's head over to Washington, D.C. President Biden will hold a news conference on Wednesday to mark the end of his first year in office. Meanwhile, his push for voting rights legislation faces fresh opposition in the Senate. Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more on the week ahead. So, Joe, what is the #1 agenda item this week?
Well, it's voting rights. As you point out, the president has received a lot of criticism, Kaylee, for not sitting down to answer more questions, hold more news conferences. This will be only his second formal news conference at the White House in his presidency. The first was back in March, and all the questions were about the fight against COVID, his new presidency, and of course, the looming yet-to-begin debate around infrastructure, and a lot has happened since then. This time, questions will likely be a lot tougher, as it not only coincides, to your point, with his first year in office, his first anniversary, but also will likely coincide with the failure tomorrow of voting rights legislation in the Senate. We're going to learn more about that today, Kaylee. We expect a Democratic caucus meeting late today. Votes are likely tomorrow, and nothing has changed over the weekend. Majority Leader Chuck Schumer does not have the votes right now to pass that legislation or to break the filibuster. And President Biden will likely have to explain that in his news conference this week.
Okay, a lot of still work in progress then on Capitol Hill. Joe, thanks very much. Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now, European finance ministers meet in Brussels again today amid an energy crisis and rising levels of inflation. Joining us now for a preview of what we could expect to hear in Brussels, our Europe correspondent, Maria Tadeo. Maria, there are new faces, lots of the same lines, though, no doubt, being expressed, same concerns around higher energy prices and how that's going to hit consumers. What's the latest?
Yeah, Anna, there are new faces here. In particular, I'm thinking, of course, of the German finance minister, Christian Lindner, who's making his big debut here in Brussels. But I would argue the concern is the same for all of the finance ministers that we've been speaking with throughout the morning, and that is inflation and the impact that it could have on households, but also the corporates. We know what it did to EDF on Friday, and that story continues. The stock took a 25% hit. A lot of this, of course, has to do with energy prices, the energy crisis that we're seeing in Europe, particularly in that context of very tense and escalating tensions between Russia and Ukraine. It is interesting, however, this morning I spoke with the Commissioner for Economic Affairs, who told me we still believe this is a one-off. Temporary factors will cool and inflation will cool down, but he did concede it is probably going to take longer than we anticipated.
All right, thank you so much to our Europe correspondent Maria Tadeo in Brussels for us this morning. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And a massive laggard this morning is Farfetch, the online luxury fashion company. It is down a whopping 17% before the bell, already is down about 19% in 2022. The latest news there is the company's former COO is apparently in the running to become the new CEO of ASOS. Everything else moving to the downside largely has to do with technology or anything that has a lofty multiple, given the fact that yields are moving higher, and Tesla is no exception. That stock is down about 2.5 before the bell. But it isn't all bad news this morning, Anna. You are seeing some stocks moving higher, and they have a lot to do with the energy complex, with the boost in oil prices we were discussing earlier on with Christina Kino. One of those is APA Corp. It's higher by about 0.7% before the bell, Anna.
Yeah, absolutely. That would reflect the sector breakdown we're seeing here in Europe as well. Now, coming up on the program, more on the markets with Beata Manthi, head of European equity strategy at Citigroup. Where does the tech sector go from here? And on China, Diana Choileva, Enodo Economics chief economist. As rules get tougher in China ahead of the Olympics, we get the perspective of Enodo Economics. Plus, stock picker of the year. We'll break down the portfolio of Fidelity's Adam Benjamin to see what earned him a spot at the top. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York, Anna Edwards with us in London. What we are seeing here on Bloomberg Television, and of course we're simulcast on Bloomberg Radio as well, so I'll walk you through those who are only listening, is the 2-year yield. And it has flatlined at close to zero for most of the pandemic, but it is now coming back up above 1% for the first time since the beginning of 2020. And this has wreaked havoc in markets. For this reason, we see tech stocks turning tail and running, with the Nasdaq Futures down 2%. Lynn Thomason joins us, Bloomberg Markets managing editor for EMEA. And Lynn, what is this global rout that we're seeing being driven by? Is it really higher yields?
Absolutely. I mean, I think higher yields are the big story for today. Everyone's worried about inflation. What is the Fed going to do? How many interest rate hikes will we see this year? How much will we see this year? And I think, just alongside the, big story in yields is also the story with oil. I mean, you're seeing prices shoot higher today. The market is really hot. And I think that, in some sense, really underscores the challenge facing central bankers this year.
Lynn, good morning. And just to underscore how big a deal the yield move is, we've had some really strong data out from the German economy, and it's not really touching the sides. It's not really moving European assets. It's certainly not moving stocks when you might have expected it to really add to optimism. We had the German Investor Confidence Survey, expectations amongst the investor community surging to 51.7. Analysts had expected 32. So even if you know nothing about the numbers involved, there's a big difference between those, and yet it doesn't really send us higher for risk assets today.
Absolutely. I mean, there's one story in the market, and it's inflation. And in some sense, the German data feeds into that story where it shows that, economies are healthy, they're strong. And then it's almost, it's all that's good news turns into bad news that it's, could mean higher rates. And that's obviously bad for asset prices.
Well, and it's bad for big tech in particular. At least that's been the story, Lynn, over the last week or so. Is this going to be the correlation once again? We've seen it before. Yields go up, tech goes down. Yields come in, tech gets a little bit of a breather.
I mean, that's certainly what's playing out this morning. And in some sense, it's not just tech that's being hit. It's everything that's being hit. I think, perhaps a few months ago, you would have seen tech go down and value stocks go up, banks go up. But at the moment, markets are looking red across the board. You're seeing some, bright spots in energy. Banks have obviously been an area of optimism. But, it's not just tech. It's the S&P 500. It's European stocks. Even Asia's down today. It's quite widespread.
Lynn, we're seeing the Bunds about to turn positive. They're almost there, and I'm wondering how much it really matters. Is it just an interesting, round number crossing the zero bound, or does it make any kind of difference?
It's something that, everyone's so gotten used to German yields being negative, that the fact that they're positive, really emphasizes the fact that we're in a different era right now, a different world. And I think, that just puts a punctuation mark on that.
Yeah, not quite there yet. Negative by 1.6 basis points, Lynn. We're watching. There'll be a red headline across the Bloomberg if we get there, perhaps, I'm guessing. Thanks very much to Bloomberg's Lynn Thomason. Thanks for taking us through all of that. Remember, you can get market analysis, the latest thoughts from the Markets Live team, MLI Vigo. That is the function to use on your Bloomberg terminal. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter and we're going to pivot, and most importantly, we're going to defeat COVID.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And major U.S. airlines are warning of catastrophic disruptions from Wednesday's scheduled rollout of 5G wireless service. A trade organization urged government regulators to prevent 5G from being implemented within 2 miles of where aircraft fly. Airlines are worried the new signals could interfere with aircraft instruments. In China, the housing slump keeps taking its toll on the economy. The property sector shrank at a faster pace in the final 3 months of the year. Output in the real estate industry declined 2.9% in the fourth quarter. The British government reportedly may end mandatory self-isolation for positive COVID cases as early as March. According to the Guardian newspaper, authorities also plan to end most other restrictions, including remote working guidance and COVID passports. That's seen as a sign that Prime Minister Boris Johnson is prepared to let the UK live with the virus. And a study from Israel found that a 4th dose of the Pfizer-BioNTech vaccine was not enough to prevent infection by the Omicron variant. Researchers say the vaccine did raise antibody levels, but that only offered a partial defense against Omicron. And Matt, that really doesn't go very well to answering our questions about the efficacy of booster shots and really how many people need, and maybe giving more boosters is not the answer.
Yeah, well, as this thing evolves, that may be the case. I mean, it's important to remember that these vaccines were very effective against the first few variants. Had we all taken them then, we might not be here where we are with this variant, but they may have to come up with some kind of new weapon to fight Omicron.
Yeah, had we all had the opportunity to access them and taken them up with some enthusiasm then, Matt. Yeah, and as Kaylee was just saying, the conversation here in the UK certainly feels as if it's politically moving on. When will we be without any COVID restrictions at all? And in terms of booster shots, there has been pushback here in the UK around this idea of giving any 4th booster, a sense that perhaps you transition to treating it like seasonal flu with an annual vaccine instead for those who are particularly vulnerable. When we come back, we'll get back to the market conversation. Beata Manthi joins us, Citigroup head of European equity strategy. What happens to European stocks as US stocks sell off? We'll get to the answers to that question. This is Bloomberg.
end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Here's what you need to know. Traders are counting on a Fed interest rate increase in March. They sent 2-year Treasury yields above 1% for the first time since 2020. Meanwhile, Brent oil surges to the highest price in more than 7 years. The CEO of BlackRock says he's a capitalist, not an environmentalist, but Larry Fink warns that companies who don't embrace sustainable business practices will be left behind. And Goldman Sachs earnings come out a couple of hours from now. Analysts want to see just how much the firm's deal makers brought in from that big surge in M&A. That is a look at what you need to know this morning. And Matt, we need to be aware that we've got US bank earnings coming ahead of the bell stateside.
Yeah, absolutely. Goldman Sachs is coming out. I mean, we had a look at U.S. bank earnings already at the end of last week, and we had a look at a scoop by Sri Narayanan on what we're seeing in terms of Goldman Sachs bonuses. Some of the partners are getting millions of dollars in extra bonuses on top of their $1 million bonuses, on top of their $1 million salaries. So congrats to them. What we're seeing in terms of markets today, Nasdaq Futures are down. I distilled this down to, I think, one of the most important features of the U.S. market today. Nasdaq futures are off, so tech stocks leading the way down. Why are they? Because yields are rising, especially at the front end. So I've got the 2-year here, up 1% to up above 1% for the first time since before the pandemic. Crude also continues to gain, and even more so now. NYMEX crude up $1.48 to $85.30 a barrel. So there's little supply and a ton of demand, and Bitcoin rising, although still Bitcoin's relatively little change here, 42,000, and we've been hovering around this level for a few days. It does tend to move with risk assets. So normally when you see Nasdaq futures plummet like this, you would expect Bitcoin to come down as well. Maybe that has already been worked out of the system, and maybe this is sort of an equalized level of Bitcoin at $42,000. Kaylee, what do you see in terms of the pre-market movers?
Well, of course, you mentioned the fact that we're seeing oil moving materially higher, and that is leading to one exception in a really big down day broadly for equities, and that is the energy sector, the Energy Select Sector SPDR ETF, which basically gives us a way to gauge how the sector as a whole is moving in pre-market trading, is actually higher by about 1%, even as we are seeing futures broadly lower. A lot of other stocks, though, still moving to the downside, one being Goldman Sachs. As Anna mentioned, we are awaiting awaiting results from that bank around 7:30 a.m. Eastern time, so about 2 hours to go. Trading, investment banking, expenses really going to be a focus. That stock is down about 0.6%, 0.7% as a result. And then, of course, with those yields moving higher, that is putting pressure on high multiple stocks in particular, including the two largest heavyweights in the U.S. equity market, Apple and Microsoft, each down 1.5% or more. So that, of course, is creating a big drag on equity futures as a whole, Anna.
Yeah, absolutely. And Kaylee, you were pointing out what was going on that energy ETF, and that really reflects what we're seeing here in Europe. Just two sectors in positive territory for European stocks, and one of those is energy, up by 0.3%. Technology is very much at the epicenter of the selling. It is the worst performing sector here in Europe. Off lows of the session, now two technology names on the Stoxx 600 actually moving to the upside, just two, but the sector as a whole still down by 1.8%. And with all that focus on yields over in the United States, the Treasury curve really at the center of things, how much of that is spilling though across the Atlantic? Well, quite a lot it seems, and we are seeing that being picked up here in bond markets and also on gilt markets. I put gilts in here as well because we had some labour market data out a little bit earlier on. That came in pretty strongly a day before we get inflation data out from the UK. The Bank of England, of course, out in front in terms of G10 economies and the hiking cycle. The ECB perhaps being left behind, and the market asking questions as to whether that is sustainable. Kaylee?
All right, well, let's get more on these markets with Beata Monti. She is head of European equity strategy over at Citigroup. So Anna, just really painting a picture of the fact that yields are moving higher, as did Matt. Is it basically the bond market that is driving the equity market at this point?
Hi, Kelly. Thank you for having me. Indeed, we think that tighter monetary policy and higher bond yields are going to be one of the biggest themes driving the markets this year. And if you were to choose one indicator that you could have a foresight on to know what the market is going to do on the day, I would pick the bond yield, and especially the direction of the real yield, which we think is going to be key in terms of determining the leadership between value versus growth in the market.
Value versus growth, and which do you think is going to take over this year? I mean, it seems like every year for the past few, people have forecast the return of value or that rotation, and it hasn't really panned out.
That's a fair point, Matt. So the way I look at it, as I look at the forecast that our rate strategies are giving me on the real yield, and in the US, we think that real yields from around negative 70 basis points now are going to move to negative 25 basis points. So still quite some way to go. And we estimate that this could drive another 10% outperformance of value over growth in Europe. We've already seen around 10% of that happening. So in the near term, as long as bond yields are going to move higher, we think that value has more to gain.
What do you think about, it does also seem, Beata, like every year strategists say, Europe is the place to be now. This is Europe's year because it's so undervalued compared to the U.S. Now, there may be some structural reasons for that, but we're hearing the chorus getting louder on that point this year. How do you look at European equities versus the U.S. markets?
So being a European equity strategist, I'm pleased to see this move in bonds moving higher, because we think if there is one indicator that could make Europe outperform the US, it's going to be higher yields, and especially higher real yields. So, and the reason for it is structural in terms of how the market is built, right? So basically higher real yields are a big headwind for the valuations of the very expensive parts of the market. So growth, tech, we estimate that in Europe, the valuations of luxury goods or tech, these really highest rated sectors, could derate by on average 5 PE points if real yields reach this negative 25 basis points, as I've mentioned, we have penciled in our forecast. So we think the US has more to lose in this move higher on the real yields than Europe. Of course, Europe has some parts of some expensive parts. However, it still has more value bits that will do better and make Europe outperform. And one thing I really would like to mention in Europe, a standout to benefit from the higher real yields, is the UK, which is our favorite way of playing the value rotation.
Okay, Beata, and tying into that, I was just going to ask you about oil names and oil stocks, because oil prices continue to move higher, 87.63 on Brent. That typically plays to the advantage of the UK. And what you've been saying there about value, I mean, year to date, looking at the factors to watch function on the Bloomberg, we've seen European stocks already benefit from that value trade. It's certainly been driving some of the strategies that we've seen year to date here in Europe. So how important is the oil story to that UK narrative?
It is very important, especially for the...
Okay, so you prefer basic resources. You talked there about political risk. We have a number of elections that lie ahead here in Europe, Beata. Do any of those strike you as crucial in terms of the outcome and in terms of how markets perceive political risk? What are you going to be watching for?
So, as you mentioned, we have quite a few important elections coming through this year. However, we think, so we are used in Europe to this of watching these big events and risks around the events, the elections themselves. We think this year is going to be different for Europe. So we don't see too many risks for the markets from the presidential elections in Italy or later presidential elections in Europe. So we think, if anything, it's a positive step for the markets. The outcome should be a normalization for the equity markets, and really a reason to buy these particular markets, if anything. But it will be more about the policies coming out of it, right? So this is more important than events on their own. So if anything, I would say the German policies coming of the German coalition, so the past events of the election from the last year is more important than the two upcoming elections.
Okay, Beata, thank you so much. Beata Manthe, Head of European Equity Strategy at Citi. Coming up next on the programme, we continue to talk about risk, this time with regards to China. Diana Choi-Lever, Enodo Economics Chief Economist, joins us. What does she make of the Chinese data we had recently, the PBOC's move, and what lies ahead for China as we head towards the Olympics? This is Bloomberg.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story. How are you thinking about those dynamics?
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lines in New York and Anna Edwards in London. Now, China's President Xi Jinping is calling on nations to secure global supply chains and prevent inflation shocks. The call for stability comes as she prepares to secure a third term in power. Joining us now to talk about the economy in China is Diana Choileva, a Noto Economics chief economist. And Diana, you know, it's interesting. I've always thought of China in a very rudimentary sense as a command economy, meaning that the party can basically pull levers and make the economy grow at whatever speed it likes. They now have some exogenous shocks that they can't control, like COVID, as much as they would like to be able to. How much in control of the economy is President Xi still?
He is. But of course, Omicron, being so highly virulent, presents a key political and economic challenge, because the issue is that sort of Xi snatched victory from the jaws of defeat, claimed COVID victory early, but it was predicated on a very all-of-nation effort to control, track, and trace. And of course, the moment the virus became a global pandemic, actually any country in the world is only as strong as the weakest country in the world. So actually, he's backed into a political corner. He cannot easily abandon zero COVID policy. And at the same time, we have now the largest migration on the planet with the Chinese New Year. We have the Beijing Olympics. It will be a real test. If it was not for Omicron, actually, the authorities have started throwing money at the economy and would have been successful at getting decent growth in H1.
Well, Diana, let's talk more about Omicron, because Goldman Sachs last week cut its estimates for growth for China for the year down to 4.3% due to the variant and the lockdowns that have resulted. What is your estimate of the growth impact that will have?
Well, look, it's highly uncertain. It's almost impossible to figure out how it will impact. So I think there's even no point. What we do know, though, is that we have to monitor those developments very closely and assess, first of all, the political damage and how the authorities will respond. Already we see calls from the central government to local governments saying, look, don't be too strict, you know, judge how you deal with lockdowns and Omicron and all of that, but at the same time ensure that you don't stamp out consumer spending during the Lunar Year holidays. Actually, consumer spending has been in the doldrums in China, and it's really key, if the economy is to grow sustainably in the future, that the authorities try and do everything they can to foster it. Unfortunately, they're doing the exact opposite.
Diana, what you were just describing there about the communications between central and local government, is that the policy of dynamic clearing that some people have been writing about and suggesting this is a bit of a pivot away from the COVID zero policy? Would that be to overstate it?
I think it would be, because essentially it's just a PR exercise. You know, clearly they cannot have zero COVID, so now they have renamed it as dynamic clearing. But that's not a clear-cut abandonment of the policy of trying to keep it as low as possible and address it instantaneously if necessary with lockdowns. So it is not as yet a change in the policy. It's just a bit of window dressing, because clearly absolute zero is impossible.
How do you expect the Olympics to go, Diana?
Oh, I'm really worried that we could sort of have a political altercation around it. I mean, obviously there is the diplomatic boycott by some countries, but in these strict conditions with the danger of Omicron, how will the athletes, international athletes, be treated? The potential, I think, for something coming out of the Olympics that has serious geopolitical repercussions is there, definitely there.
Yeah, you certainly don't need much imagination to think there could be a bit of a culture clash when athletes descend. Diana, thank you so much for joining us. Diana Choi-Lever, Enodo Economics Chief Economist, and of course, I mean, in the context of the way that COVID is handled in China versus elsewhere. Now, coming up on this program, the best stock picker of 2021, how he earned the title by betting on an industry that was at the center of the supply chain crisis. We've been writing about him and getting his insights. More next. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Well, the best stock picker of 2021 scored a rare trifecta of money management, and he did it by betting on a sagging semiconductor industry whose shortages contributed to the worst supply chain woes in memory. Matt Winkler, Bloomberg Editor-in-Chief Emeritus, joins us now for more on his latest column on Fidelity's Adam Benjamin. So, Matt, we all know about the semiconductor shortage. We've covered it extensively for the last year and change here on Bloomberg Television. How did he play it better than everyone else?
Well, he's been doing it for 20 years plus, he would say. This is something that, or a subject that he's been following really since he became a money manager. And it goes all the way back really to the turn of the century. So if you think about it that way, he probably knows more than most of us do about semiconductors. And what he did in the past year was an example of the benefits of active management. You know, he invested heavily in some stocks like Marvell, in NVIDIA, and he lightened up on some other stocks like Intel. And the result of that combination made his performance unbeatable.
What's the trifecta?
The trifecta is that if you look at last year, you had energy and autos, of course, leading the stock market. he, of course, manages only semiconductors. So he not only beat his own category, the benchmark for semiconductors, he also beat energy, he also beat automobiles. So that doesn't happen very often, by the way, in money management.
What's his outlook for semis and for the supply chain this year? We're all eager to know how quickly this situation can be normalized.
So he does say that when you think of semiconductors, they are the brains of just about every end market we're talking about, whatever it is. So that's not going to go away. So the demand for semiconductors is probably going to be robust as far as the eye can see. At some point, because we're all talking about it and thinking about it, we are going to move some production inevitably back to the U.S. We are going to figure out how to correct the bottlenecks in the supply chains. And so the supply eventually will catch up with the demand, but that doesn't appear to be anytime soon.
It's interesting, if I were reading the column for investment advice, the major take would be AI. It seems like he thinks we're in the beginning of a long, more than decade cycle.
Absolutely right. The one trend he said we're going to be thinking about, talking about, probably for the next 10 years is artificial intelligence. And again, it comes back to the fact that whenever you think of any industry, artificial intelligence is really what everybody is contemplating. And that's where semiconductors have the inescapable element in that industry.
Matt, good morning from London. It was really interesting reading your piece, and you've emphasized how he has decades of experience analyzing this sector. It was interesting that for somebody who's so focused on the digital, so focused on the role of chips in almost everything that we do these days, it was a very offline experience that he credits was giving him special insight. He goes to a conference, the one that takes place every year in Las Vegas, and that's the key. That's the place he gets all the intelligence.
Yeah, he would say, and he does say, that that's a essential part of what he does, which is, you know, roaming, if you like, every year, the Las Vegas
CES
convention, center, and talking to people, not so much about the brands, but talking to people about what is it that they're most interested in, what is it that has their imagination, stuff like that. And that, for him, is vital intelligence.
You mentioned how this is kind of a testament to active versus passive management. What is the broader read through here about the direction of funds of the future?
Well, you know, he comes from Fidelity, and my colleague Shinpei and I have been doing this column for 7 years now. And one of the things that we've noticed is that in 4 of the 7 years, Fidelity has been the #1 stock picker, and that is because it is committed to active management, always has been. I mean, go all the way back to the Magellan days, where I come from. White-haired people like me. But, I mean, what it proves is that active management is not only alive and well, but it's very effective, particularly at times like this.
Okay, arguments for stock picking and for active management. Thank you so much to Matt Winkler, Bloomberg Editor-in-Chief Emeritus. Really interesting read. The top 2021 stock picker wins with semiconductors. That out on the Bloomberg terminal now. More Bloomberg surveillance is ahead. We will hear from Standard Chartered CEO Bill Winters and World Bank President David Malpass, among others. Those conversations coming up shortly. Of course, we'll focus on the U.S. bank earnings season as well. Goldman Sachs reports shortly. There'll be a big focus there on investment banking and the fees that are earned in that department, and how much of those have to be spent on wages and compensation. That very much at the heart of the U.S. banking story right now, along with higher yields. We track those Treasury yields higher and higher. This is Bloomberg.
of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
There's going to be a push-pull between the fear of the Fed and Fed moving off of ultra accommodation.
The interest rate environment is probably the most important economic backdrop over the course of this year.
That valuation support is not particularly good in some segments of the market.
A lot of froth, a lot of money has gone out of some of the more speculative parts of the market.
This is an opportunistic stock picker's market, but you have to do your homework.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Yields up, stocks down. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your stock market on the S&P down 52, down more than 1%. Tom Keene on the Nasdaq, we're down almost 2 percentage points this morning.
Yeah, big move, and I'm going to go right to the 2-year yield. I know that's what Lisa's focused on. At 104, we just break out to a new high there. John, to put that in perspective, Valentine's Day, pre-pandemic, the 2-year yield was 1.43%. Imagine where we were a number of months ago and how rapidly we're getting up near that level.
We're getting back there and getting back there quickly. Over at Wells Fargo, Mike Schumacher looking for 160 by mid-year this morning, 180 on 10s, Tom, through 88 and crude. And then we've got some Goldman Sachs earnings a little bit later this morning.
Well, the Goldman Sachs earnings are really going to be profound. I think Keith Horowitz was out with a note on J.P. Morgan. And, John, the big shift there is maybe what we're going to hear with Goldman Sachs, which is full steam ahead on capital development, innovation, and just simply spending money. Horowitz brings a price target down on J.P. Morgan, still up 11% is where he's looking. You wonder if we see the same thing from Mr. Solomon over at Goldman Sachs, where he just says, we're going to spend money to stay out front.
Well, that's for Goldman, Lisa. I think a lot of people, a select few, looking to get paid and get paid big time.
That is exactly where I wanted to go. I love how you can read my mind at the beginning of the week. But why is this sort of surge in Fed expectations really coming now, right? What happened? It wasn't Fed speak. It was some of that commentary from the CEOs of big banks saying they're seeing wage inflation perhaps like they haven't seen in decades. And how much is that feeding into the zeitgeist of this Tuesday?
I think they're hoping, Lisa, they have to do this once and not repeat the act next year and the year after that and the year after that.
Perhaps. However, if you look at real wages, there's still a long way to catch up, especially as oil prices climb and especially as consumer prices are not showing signs necessarily of slowing materially in the face of labor shortages.
A ton to get through this morning. Let's start with the stock market. Futures down 53 on the S&P, down a little more than 1%. On the Nasdaq, down 283, down 1.81%. Into the bond market where the action is. Yields higher by 2 or 3 basis points on 10s through 180. Let's call it 181 on 2s through 1 percentage point. In Germany, getting getting closer and closer to zero. And don't take your eye off crude. 85 on WTI. And Lisa, briefly, we broke through 88 on Brent for the first time, going all the way back to 2014.
And there's so much here. It's definitely demand picking up, but it's also some geopolitical concerns that I'm sure we'll touch on throughout the morning. As we've been saying, 7:30 a.m., Goldman Sachs releases their earnings. Very much a trading story, very much a banking story. We heard about their oil unit and how much they earned. However, they've been lagging behind other financials, and frankly, even as they outperform, as all financials are outperforming the S&P 500, they really haven't managed to deliver the same kind of return. How much are they going to say their lending unit is actually gaining traction at a time when yields are rising and the consumer is starting to borrow more? Then at 8:30 a.m., we're getting to interview Standard Chartered Chief Executive Officer and Executive Director Bill Winters. The interesting thing about Standard Chartered is that the vast majority of its business is in the emerging markets, which have underperformed over the past year. And a lot of people are wondering, what's the outlook, especially with China was slowing to the extent that it is, at the same time that they're potentially cutting rates going in the opposite direction. It'll be interesting to see the opportunities that arise from that. And at 8:30 a.m., we get the Empire Manufacturing Survey for the month of January, the first read really on activity amid this Omicron surge. The expectation really is to get some insight on supply chain disruptions, right? I mean, the feeling, John, has been that we are starting to see the peak and that perhaps things are starting to ease, but I hear that every other month, and then we go back to where we were before.
And then crude kicks in a big way
exactly.
as well. Price is higher, price is higher. Lisa, thank you. Ton of research this morning, Tom. Do you want to start with Mike Wilson over at Morgan Stanley? Our new Fed forecast simply brings forward our call for lower equity valuations and raises the risk in the first half of the year. His price target, of course, year-end, Tom, on the S&P, 4,400.
Well, yeah, I mean, everybody's going to recalibrate here. There's no question about it, John. I haven't done it yet. I'm sorry. I'll do it here in a moment where we recalculate the drawdown. And the answer is, I mean, maybe we're shifting to single-digit analysis. Lori Calvasina says we'll see moderate gains. She models out an up 6%. I don't think anybody watching or listening is really ready for that. We're ready for the drama of up big, down big. What about a slog for 2022?
John Stolford expects something better than that. The Chief Investment Strategist at Oppenheimer Asset Management joins us right now. Hey, John, good to catch up. 53.30, your year-end call. A lot of challenges to that right now, John. Why the optimism still?
Oh, the optimism still because it's very early in the year. And right now, we would expect we're right about where we should be with all the nervousness around the variant, the nervousness about the supply chain. When will that be resolved? The nervousness around a shortage of labor. But most of this, you know, is now beginning to be responded in terms of the inflation worry by the Fed's pivot, with an outlook now that it's not only, you know, the accelerated pace of the tapering of the bond purchases, but then beyond that, the likelihood of raising the Fed funds rate after March, and thereafter looking at reducing that balance sheet, all of which we see very positive. We like the pivot, and we think, though, where we are right now, very early in the year to start calling an end to better things ahead.
John, have we forgotten a drawdown? Have we forgotten a correction? Have we forgotten how to enjoy going down where John Templeton said shares were on sale?
Amen. Let me tell you, I think many people have. Those of us who've been around for a while, you know, this is going to be my 39th year in the business. Gasp! I can't believe it. But when we look at it, you know, just recently, if you look at the last Fed funds hike cycle, it was from, what was it, December 2015 through December of 2018. And during that period, you had a fourth quarter drop of around close to 20%, as I recall, based on expectations of higher inflation and a Fed that would continue to raise. Then the Fed pivoted. And actually, when we look at that period from 2015 to 2018, best performing sectors, as I recall, were information technology, utilities, financials, and consumer discretionary. So a mix of value and growth with tech at the helm. We could well see something similar to that, thinking of history may not repeat itself, but it often rhymes.
John, a lot of what you're saying seems to jibe with consensus. We got the Bank of America Fund Manager Survey from earlier this month out this morning, and it looks like investors are the most overweight stocks versus bonds going back to 2011. They are overweight commodities. They are overweight bank stocks. Some of the plays that we keep hearing about, does it concern you that the consensus is agreeing with what you think?
Well, it always worries me, Lisa, when consensus moves to my side of the boat, needless to say. But what is comforting is interest rates are rising, but they are rising at a high percentage based on where they were just a few weeks ago, but the reality is borrowing is still next to free for borrowers. It's still a rough environment for people who lend money. And a better environment for issuers of debt. So we think we're moving towards the next new normal. We think it's a positive move, and we think stocks are going to reflect that.
When is the new normal not feasible in terms of how high rates can go and still continue this, I don't want to say Goldilocks, but very nice environment for risk assets?
I would say if we get to a level of around 3% and we see that 3 stick. Remember, in 2018, we saw the 10-year Treasury. First half of the year, I recall the peak was around 3.11. Second half of the year, in that fourth quarter, it hit 3.25. People were calling me saying, Johnny, are we going to 4% on the 10-year? I said, no, this is ridiculous. That yield is much too high to stick there based on the rate of inflation that we have. And we think that the Fed is going to manage well. The most important thing is that it responds to the issues at hand, and it certainly has begun to do that now.
Hey, John, wonderful to catch up, sir. As always, John Stelford's there of Oppenheimer. Still bullish, this equity market, looking for 53.30 on the S&P year-end. This equity market facing some challenges at the moment on the S&P, much more so on the Nasdaq 100, down by 1.83% on the Nasdaq 100. Lisa, you mentioned the Bank of America Fund Manager Survey. That bank's overweight, the highest since October 2017. The tech overweight, the lowest since December 2008. Year after year, month after month, that was the biggest overweight, most crowded trade on the street. That has corrected really quickly over the last several months.
And this is really a rate story. This seems to be the most leveraged sector to the idea of higher base rates. At what point do people view this as baked in, right? I mean, this is my question. At what point do the rate hike expectations go too far? With now we've got 4 full rate hikes priced in by the beginning of next year. I mean, at what point do people say that's enough based on where real rates are going to be at the end of this cycle?
I don't know. We got some more fuel on that going into the weekend.
Yeah.
Bill Ackman going into the weekend was talking up maybe a 50 basis point hike in March. I know people are starting to think about it. I'm not saying it's going to happen. It's no one's base case at the moment. But Deutsche Bank and Matt Lazzetti and Peter Hooper, 2 people that we really respect, good friends of this program, Tom. The Fed may need to return to a more neutral policy stance sooner rather than later. Events argue for the return to a more preemptive approach to setting monetary policy in order to avoid the harder landing down the road caused by having to deal with a more persistent inflation problem. That's the conversation shift. Never mind the 50 basis point stuff. Don't get lost in that. The conversation has shifted really, really quickly in just a month.
The conversation has shifted to earnings, and I like what Mike Wilson says at Morgan Stanley, where he says rates are going to become less of a determinant, and it's about earnings, including the Goldman Sachs we're going to see. John, I think we've forgotten how to go down. Standard & Poor's drawdown, -4%. Dow, -3%.
Well,
Nasdaq 100, an outright crater, -8%. These are nothing burger, John.
Yeah,
nothing burger is my word for today.
John, I've got to say, I love how you say, Bill Ackman's calling for a 0.5% rate hike, all in one, bop. Just not me, him.
I'm not saying that. I don't have a call.
I know.
I'm not giving my call. You know what happens? You mentioned that, and then all of a sudden the abuse. Who said, what does Bill know? He's talking his book. Someone said something. There you go. Equities down 54 on the S&P, down a little more than 1% on the S&P. From New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. Major U.S. airlines are warning of catastrophic disruptions from Wednesday's scheduled rollout of 5G wireless services. A trade organization urged government regulators to prevent 5G from being implemented within 2 miles of where aircraft fly. Airlines are worried the new signals could interfere with aircraft instruments. A study from Israel found that a fourth dose of the Pfizer-BioNTech vaccine was not enough to prevent infection by the Omicron variant. Researchers say the vaccine did, however, raise antibody levels, but that only offered a partial defense against Omicron. In China, the housing slump keeps taking its toll on the economy. The property sector shrank at a faster pace in the final 3 months of the year. Output in the real estate industry declined 2.9% in the fourth quarter. BlackRock CEO Larry Fink is hitting back at critics who say that considering environmental impact in investing is politically motivated fad. In his annual letter to CEOs, Fink wrote, "We are not capitalists, not environmentalists," but he warned that companies will be left behind if they don't embrace sustainable business practices. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Earnings season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal.
Where are investors seeing the weaknesses?
It means profits down the line. Earnings season on Bloomberg Television and Radio.
The most recent version of it is not going to happen, but if you look at the core of the bill, I still believe we're going to find the core of this bill, whatever we call it, we're going to find a core of the bill and pass it, and it will deal directly with some of these inflation concerns.
Senator Tim Kaine there of Virginia on Build Back Better, the big effort down in Washington, D.C. From New York City this morning, good morning. Tom Keene, Lisa Brabitz and Jonathan Ferro, some big price moves we need to talk about. Futures down 53, down more than 1% on the S&P, on the Nasdaq down 272, off by 1.74%. Yields are higher on a session on the year, big time. On the day, up 2 basis points to 180 on 10s. Yields high at the front end, much more so. So on the session, the curve is much, much flatter. Twos back through 1%. And Tom Keene on the year, never mind on the session. What are we, 3 weeks into this? Not even. We've had a 30 basis point move on 10s. We have had a 30 basis point move on twos.
Let's call it first derivative January. You're going to hear a lot of calculus talk for the rate of change, John, the first and second derivatives here, the accelerative force that we see. And some of that's going to be compounded by a guesstimate of what GDP growth will be.
Tom, how far do you think we push this? It's essentially Lisa's question this morning. Where's the upside surprise come from? With 1% on twos. Wells Fargo, Mike Schumacher, felt like an outlier call a number of weeks ago. He was looking for 150, 160. Turn of the year, middle of the year, Tom, on a 2-year yield. That could be messy. That's his call.
I'm going to go back to economic growth in a somewhat fully employed America. There's a dearth of economic data this week. We've got retail sales. As you know, John, last week we had, I think it was CPI Wednesday, Faro Thursday, and retail sales Friday. Whatever it was, the answer is we don't have that this week. And the idea here of getting in economic data while we get in earnings, as Mike Wilson nods to, is going to be critical.
Only a few bad economic data points, Tom. It only takes a few and the conversation shifts markedly. All of a sudden, people are talking about inflation, 6-7%, and growth rolling over. Yeah. That'll be the conversation. Are we hiking into weakness? And all it took was that retail sales print on Friday, Tom, to really give that flavor to the conversation pretty quickly.
Yes, no question about it. And of course, we've got to get updated Omicron statistics off of the holiday weekend where the statistics maybe are a little bit sketchy. Are we back to 2,000 deaths? Joe Matthew joins now, Bloomberg Washington correspondent. Joe, I love what Jeff Stein did in the Washington Post this morning. It's not a postmortem, but it's sort of a state of play for what he calls the liberal policy apparatus wrapped around the President of the United States. What does the liberal policy apparatus do this Tuesday morning?
Boy, cross their fingers, I guess, Tom, but it's not looking good. To your point, picking up the pieces from Build Back Better is one thing we can do right now, although I suspect we'll hear more about it as we get closer to the State of the Union on the 1st of March. But this week is about voting rights. This is close to the hearts of progressives. We expect a vote as early as tomorrow on this. And, Tom, it's expected to fail. Nothing changed over the weekend. Joe Biden, Majority Leader Chuck Schumer are going for it. If it fails, they will then go to a vote to kill the filibuster. That's not going to go anywhere here either, thanks to opposition from Manchin, Sinema, the same two names we've been talking about. You know how this goes in Washington. You vote to make a law. Sometimes you vote to make a point. And that appears to be what Democrats are doing this week ahead of the president's second only formal news conference so far.
Well, you know, we're going to get this, and we're going to get the voting rights thing done. History, let's go. As you say, they make a point. Then what for BBB? I mean, do they break it up again in the zeitgeist this morning as the idea of take smaller pieces as the moderate Democrats are in a modest panic over do something? What's the next step in Build Back Better?
Well, of course, lawmakers were telling us through the summer, through the fall, in the Build Back Better debate, Tom, that they didn't have the votes to do these on individual pieces of legislation. That's why they wanted to do this comprehensive bill through reconciliation and pass it along party lines. Well, that never happened, and it's not likely going to happen. So, again, remember I said vote to make a point. Let's say Democrats come out with a universal pre-K bill, a climate bill, maybe a paid family leave bill, or a child tax credit bill. All those could see the light of day as individual pieces of legislation, wouldn't likely pass. But in this midterm election year, they could then go home and say, hey, look, we passed this in the House. It didn't get through the Senate. We're working for the people, instead of saying we came up with nothing.
And perhaps this is going to be nice window dressing, but at the core, the Quinnipiac poll last week that showed that President Biden's approval rating at 33% is the lowest in his presidency and the lowest for any president at this point in their term, other than President Trump, former President Trump. How does he move this forward? I mean, what is the real reason behind his sinking approval rating?
Well, look, a lot of this has to do with inflation, and I suspect he's going to get some tough questions about this in his news conference tomorrow. Again, we haven't had a lot of these. This president has been criticized for not sitting for many interviews and not holding many news conferences. This is only number 2. I went back and rewatched his first one from March, which is my problem. But look, it was all about COVID. It was all about the looming debate, the yet-to-begin debate about infrastructure. It's going to be very different this time. It's going to be about inflation. It's going to be about voting rights. And where Tom went with what happened to Build Back Better, where's the rest of the progressive agenda? Keep in mind, though, they're doing this today, tomorrow on voting rights. Could be as soon as tomorrow, but senators are back today to light a fire under the base. They know this is not going to pass, but could carry them through a midterm election year with some more passion.
Joe, talking about inflation, oil prices are rising, and today actually Goldman Sachs increased their forecast, expecting $100 Brent crude by the mid-year elections. They didn't talk about the elections, but this really feeds into that. I mean, is there anything that the administration is talking about to try to bring those down or even jawbone them down in any way?
Not so much. I mean, that strategic petroleum reserve release was some time ago. Those who were skeptical saw this coming. And the president's going to be talking about this as well. Look, they're also trying to investigate potential gouging and so forth. That makes for good talking points. But we have to remind ourselves that the president does not control oil prices or, frankly, inflation as they continue to defer that story to the Fed. It'll be interesting to see how he addresses these tomorrow when he's in front of the cameras.
Joe Matthew, thank you, of Bloomberg. Looking forward to the show a little bit later. Sound on Bloomberg Radio weekdays at 5 p.m. Eastern Time. Lisa, 1-800-OPEC. is going to be the number they have to dial. That's where the conversation is going and moving too quickly. Crude is up by more than 10% year to date. We had Brent earlier this morning through 88 briefly. Right now, 87.60. WTI, 85.27.
And then there's a situation with Russia and Ukraine that seems to be heating up. There seems to be no resolution on that. The joint response from the United States, unclear, and all of the geopolitical concerns continuing to heat up. I mean, how do they address this? And they got to do it if they want to bring down oil prices in time for the midterm election.
Tom Keene, this is delicate. That Goldman forecast that Lisa brought up, triple-digit crude Q3 this year. What else is going into Q4? This year, well, we've got a conversation about some midterm elections, haven't we?
Oil is way hard to predict, John. Everybody knows that, including the best minds that we talk to on this, including Jeff Curry at Goldman. But I would suggest technically with this breakout at $88 Brent crude, it's basically an extrapolated free path up to $110 a barrel. Rarely would I say that. But that's technically what the chart says.
Numbers we haven't seen in 7 or 8 years in the commodity market. Yields haven't been here for a while either. 181 on 10s. Futures down 1.2% on the S&P from New York City. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance.
would you like to achieve next in Saudi Arabia?
As you know, Barrick is invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayid copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Wall Street getting back to work and getting back to work, sending equities lower. We're down 53 on the S&P. We're down a little more than 1%. On the Nasdaq 100, down by 1.83%, down about 285. This relationship between equities and bonds right now is where the debate, the conversation is at. If you switch on the board and get to the bond market, we have breached some interesting levels now. 2s through 1%, 10s through 180, 180. And look at this, year over year. What a move it's been. We cratered lower through last year after peaking in Q1 and then into this year. I'm not sure how many people expected a 30 basis point move in just a couple of weeks. And that's what we've had on 2s and on 10s. And this conversation at the Fed has shifted as well really, really quickly. Middle of December, we had that Fed meeting, the news conference. People thought it was dovish. They thought it was dovish based on what the price action was doing. We've come into this year, we're talking about a massive pivot and maybe the Federal Reserve needing to do some more work. Deutsche Bank asking that question, Bill Ackman asking that question, Tom Keene asking the question that maybe 4 hikes this year is not enough. We got a flavor of that, a hint of it from Jamie Dimon on the call on Friday too.
Yeah, the parlor game is going to shift if this yield move continues. At a 104, John, can you imagine a 110? I don't know where those breakout points are, but what I would counsel, John, is this is not a normal Tuesday of a 4-day work week. It's like land on the ground, let's go.